10 seconds. Market on open imbalance. S&P 500 buy side 101.3 million. Nasdaq 100 buy side 1.4 million. Dow 30 buy side 10.4 million. Mag 7 buy side 1.6 million. In 10 minutes' time now, at 9:45 a.m. Eastern Time, we get the Bank of Canada rate decision, forecast for no change at 2.25%. We also get the Bank of Canada rate statement. Intel shares fall 3.6% amid Russian missile-related lawsuits. Microsoft shares down 2.5%. So in 5 minutes time now at 9:45 a.m. Eastern Time, we get the Bank of Canada rate decision. The forecast is for no change from the prior 2.25%, and with this we get the Bank of Canada rate statement. China are to accelerate approval of overseas drugs that are urgently needed. The SIBO volatility index at over a 1 week high, last up spot 55 points at 17.43. 1 minute remaining. I'll lead with the Bank of Canada rate decision. Ten seconds. No change, no change. Rate remains unchanged at 2.25% as expected. So seeing comments from Bank of Canada here. They say Q4 GDP growth likely to be weak. Final domestic demand will grow in Q4, but will be offset by a decline in net exports. Canadian labour market showing some signs of improvement. They say Q3 GDP growth was surprisingly strong, largely reflected trade volatility. Canadian economy is proving resilient overall despite US tariffs, according to Bank of Canada's Governor Macklem. Macklem also says that we agreed a policy rate at the lower end of the neutral range was appropriate to provide some support for the economy. Inflationary pressures continued to be contained. Macklem says our view is that GDP will expand at a moderate pace in 2026 and that inflation will remain close to target. Macklem says the StatsCan GDP revisions may explain some of the resilience we have seen in the recent economic data. Revisions to GDP suggest the economy was healthier than we thought before the sanctions hit. And Macklem says we expect inflation to rise temporarily in the near term, reflecting tax holiday a year ago. Banks expect that the government spending increases unveiled in the budget will contribute to growth of both supply and demand. So again, Bank of Canada left rates unchanged, 2.25% as expected. We have posted the Bank of Canada rate statement on the feed for those interested. Off the back of this, just seeing some weakness in the Canadian dollar as well, following the rate decision and rate statement. Again, in the statement, they did note that Q4 GDP growth is likely to be weak. Canadian 2-year yield falls to the day's low following the Bank of Canada rate hold.
Be on here in just a second, guys. Do. Up there. So yeah, I've got this cleaning glasses ritual every morning here. We got FOMC day today. Happy holidays to you out there if you're celebrating the holidays. I might turn that one off. Come on with that. Okay. Good morning out there. How are you all doing? Today's FOMC day. Go over here. Let's start with We'll start with expectations. We'll go to gamma, and then we'll do a preview for you before we begin, or before we get to the actual expectations. Hold on a second here, guys. Thanks, I appreciate you. What we'll do is we'll go over the expectations on the charts. We'll go over gamma to see where, if there is a drop,
China
where we should be looking for
$6.9 billion in November.
The market to be bought.
Emerging market ex China at $12.1 billion outflow.
That
was
voice news disconnected.
Well, we're also going to go over some data, because some of this data might matter in the coming days after FOMC, and depending upon the language in today's guide, forward guide. What else we'll do? Let's start off with, today is a binary event. Let's start with that. So today is FOMC day. I consider these things like ERs or unemployment report, anything like that. I consider these things to be one-offs that you're gambling. So you might be right or you might be wrong. There is a thought that I had about this, though, this morning, which was which ties into looking at prior Decembers with you. If you look at all the most recent prior Decembers, we tend to have a big downstroke into FOMC. No, not FOMC, excuse me, into QuapX. Right around into like the 20th, 21st, 19th, somewhere in there. Every year that I've checked in the past 6 or 8, I think 6 years, I think I checked, and December was very volatile. What's fascinating about that is yesterday we spoke about one of the hawkish cuts that we had in a December, and that the market went down in that instance. We also had another hawkish cut in October that the market went down in as well, but both of those cuts were unknown. It wasn't known that they were going to be hawkish cuts. So this one has been telegraphed. That would be the only thing I could see where, it's the only thing that I can see where maybe we get an up trade and not a down trade. But even when I thought about that, I cannot think of a single, there might be one, but in recent memory, even on an up move, I've never seen a mean reversion afterwards, at least a mean reversion. So a lot of these binary events, the real move is after the FOMC decision or after an unemployment rate or something like that. Hold on a second here. I'm just go through a couple things on this. And here's an example here. We've got the Fed press conference, or excuse me, the Fed interest rate decision. It says here is at 3, but I believe it's at 2. I must have something wrong with my timing here. And then the Fed presser is at 2:30. And then what's interesting is we have lots of data coming in that impact short-term rate or short-term rates. And we've got on Thursday initial jobless claims, continuing claims, jobless claims 4-week average, and then thereafter we get NFP, of course. We get NFP on Tuesday, the 16th. So we have employment change, ADP employment change at 9:15 on Tuesday as well. So some of this stuff could have some carry through after today. So if you are gambling today, there's a couple things to say to you. Number one, historically, regardless if we know it's a hawkish cut or not, we tend to sell off in these things. Number two, even if we rip on these things, we'll likely sell off again after this event. So if you want to wait to position, you may have a chance to reposition after today's event. And we're going to talk about expectations from here. The only bullish thing that I can see would be the fact that this being if we get the cut of 25 basis points, that it is a hawkish cut. And now we'll go over this in detail this morning because there is some interesting stuff to talk about. I'm going to highlight some stuff from Wolf Richter. I'm also going to highlight some stuff from BBG. And I think I've got one other thing to show you from Rubner this morning. So, and we'll talk about what these guys, all these guys have for expectations. And there's some juicy parts in here. So we want to talk about those today because some of the language today is going to matter. And there's a lot of pontificating out there about the data. And a lot of it has been inaccurate. It's not actually the data. So I'm fascinated to see the Fed typically rarely have I heard the Fed not give you the actual data and what it means. Every once in a while, I'll hear something small that's inconsistent, but otherwise, when we get to these days, typically you'll hear the actual truth that goes against what you've been fed the prior weeks leading up into an FOMC decision. So let's start with this. Let's start with the chart, and then we're going to look at gamma, and then we will look at. So did we clear this out this morning? Yeah. Okay. So we cleared this out this morning. This was the after hours low, or pre-market low down in here. We touched that one, so we're going to go back up in here and likely try to clean out this stuff up here. And we also have a couple things to take a peek at here, which would be, does this run away? Does it not run away? You want to be watching closely 638.96 and 684.45. That would imply a trip higher up into this 4-hour to 685.21. But I do expect us to just get wrangled in here. You look here at, let me see here. This is, let's go back over here. This is 4:05 in the morning right in here, 4 a.m. right in here. I don't expect us to come up any higher than somewhere up in here until we get into this decision. Now, speaking to you about these prior Decembers and bull runs, I couldn't find a single example where we didn't sell. Not a one. So we will look for some kind of a dip buy. Go over here. And just get rid of this stuff for now. We'll come back to it. We'll put this back on there again. We already did the after hour low, or the AH low. Don't need that anymore. Did that already. Get rid of this one right here. And this is kind of the base case here. Push higher right here. Grab some liquidity. Get hedged for a downside move. Try to target 677.12. There are some other places of interest below this, and we're going to look at those right now as well. So we're going to take a peek at this one right here. We already know about this one right here, so we don't need to put this one in. Make this one green, just so you can see where it is. There's another halfback trade with the close of the gap down below. This is where the real money is, the real buyers. I'm going to put one right here. This one is at 672, 673. I kind of like the idea of trading this gap closure right here. I'd really like to see like the bloodbath down here, break down and below, and then just kind of bounce around in here. If we can start making some highs, maybe buy SPY, sell some puts. And then we have one or two lower. We got one more right here at 667. And we have the big boy down below in here. CJJ used call out. That's 651.41, 650.20. If the tone from the Fed, we'll talk about the exact tone you're looking for a bloodbath 2 this morning. I do have that information, so if you want to know like how does this get received in a really negative way, what you'll be looking for, any kind of change of language, we'll talk about that some more this morning. I don't think you're going to get that, but I would expect here if you're getting if Jerome Powell gives you, thank you. If Jerome Powell gives you the cut, that would be the dovish sign. And so just to counter that, to even it out, balance of risks, that's the story that he's been giving you. So expect some more negative language. Or at least if you don't get it from him, you'll get it from reporters in the Q&A later in the morning. So just maybe one more second here. We'll take a peek at this. If you are looking, if your idea is that we go up here, this is one of the things I want to discuss with you here. I posted this on Twitter last night. I hate selling off into these events. Can't stand it. And I would have preferred yesterday to have came up into the close yesterday and sold this down into today. Whenever we come into these binary events, I cannot ever stand selling down into them. Whenever I see that sell down into them, it makes me worry that it's the up-only party off of this. Now, you can come back down here later on, next day or two, when we get that data. So I want you to just keep that in the back of your mind, that any binary event that we come into, this could be NFP. We sell down into NFP, buy it. If we trade up into NFP, you sell it at the close. An hour later, yeah, you switch your hour or two later, you switch the trade up. But there is the potential here today for, because we sold down into this morning, that you could see the squeeze up, the release of volatility, and then maybe either the press conference with people asking we start selling down, or we get up here and everybody's honky-dory, and we come back and start getting these data releases. Everybody thinks everything's fine. We get some data releases that are counter to the FOMC today, and we start trading back down here and hitting these lows at some point. Just keep this in your mind as a contra trade that we did sell down this morning into this trade here, that we could get some kind of a relief or squeeze higher. So we'll leave this one up here for you right now. Put this one back so you can see it here. We had the retracement down below over here. You got 10 a.m. flows. We're going to do 12 p.m. flows over here. I believe they're over here. There. We're going to switch to, if you guys want to take a snap of that, you can. And then what we'll do is we're going to switch to the bottom right-hand side screen over here. We're going to start, we charted this out yesterday, some kind of a downstroke in here. We know for sure that 6850 is support, but buyers remain lower at 67750, 6800. This one's a little bit off. Make sure I can get that back online. So if you are looking for any kind of weakness inside of the market, this is kind of the area to buy. The one thing to note here on this gamma flip is, let's say we blast down here. At any point, you don't want to just auto buy it. You want to look for the prior high. and still be watching this high and that new high, and then try to take this thing higher to get back up above the hourly trigger. Now, if we do lose this support here at 6775 and start heading into some slipperiness in the market, you want to be looking for 6,700, 6,650, and the used call lot down here, and the put wall at 6,500 if things go haywire this afternoon at any point. We're going to go over this part here. How does that happen at some point in probably the next half an hour or so. Let's give me one quick second here. I gotta get some water in me. Hold on here. Just gonna check the gamma this morning. Net gamma on the market. See if anything else has changed. If we firmed up any kind of hedging to the downside. 6,500 looks like the bottom of the market for right now. Put wall is 6,550, which is what we've got marked off there. There is another speed bump at 6,650. We'll call this a speed bump here. But it's not good. It's not thick gamma. So I have this as a weekly target down below here, but if we're coming down this way over here, just a little bit of a bump and back up again. I don't expect to hit 6,500, but 6,550, start looking for a turn higher, a slowing down of price, and then maybe a turn back up inside of here. If you want to take a snip at this, you can too. Remember too that the JPM collar is up here. This acts as a magnet, but also as a repellent as we get closer to it to that gamma is murdered, which is usually on OPEX or month end when most of those calls go to die. Leave that over here for you. Wall right there. If you want to take a snapshot of that, you can. Move that down there so you can see it better. That's the big question down here. How hawkish are we? How's the market reaction? And then also the fact that seasonally in December, we do sell off into this period, this OPEX period. Also remember in here, today is the 10th, and we've got time into this 19th over here, 21st, that OPEX thing. So if we're down here, killing it down here, rooting around, and then we're able to escape. This would be what happens in all scenarios. And I'll read off some of this to you about how this has been a telegraphed hawkish event in advance, and it's not something that's a surprise. So just the thought here that even if you have the kill volatility, they come back here in a day or two or even on Tuesday, blast right straight back down here, and then we're back up once again. So just be aware of that. If you've got puts on down here, you've got enough time on them, there still might be a chance or a put spread that you'll still print these things. And I looked in all scenarios, recent history on FOMC. Even when we rip up and we don't go down, we have been reversion pretty consistently. Especially on the upside moves. Downside moves, not so much. We do have some new data usually that it does have market implications where the market may be in a decline thereafter. We'll get into some of that later this morning, but I need to set that stuff up for you. So there's your gamma for today. Put this one, we get over here. I'll put this one right in here. So you can see it here. You can see that we're kind of pinned in on the 68.50. This one right here. We're going to get rid of this one here, and then there's 2 o'clock and then 2:30. There. You can see these. We'll just check GAM on the upside here really quick. So 6850, 6900 is the first. Like, that's the other thing down here. There is nothing stopping this upside move. I got to get rid of that there. It's free and clear. Just a note to you out there, if you're looking for the squeeze today, let's go back down here and look at this. So I showed you that downside stuff on SPX Gamma. There is nothing stopping that upside move right there. It's 2 o'clock. There's nothing stopping an upside move to 6,900, so just be aware of that as well. There's no resistance up here. If we begin to trade above 68, somewhere in here, check that really quick. I'll put that right there. Back to a 30-minute. If we begin to trade above this 686321, you'd expect the full trade. If we start squeezing up here, you'd expect that full trade to go all the way up to 6,900 up here. So you could see something like this, right? 25 basis point cut, and then the doom shit with the presser later to come back down. Put this back over here for you. I'm going to post some articles inside the Discord. Give me just one moment to set this up. I'll put the news squawker on.
US Trade Representative Greer says we need to look at non-autos rules of the origin in the USMCA. USTR's Greer adds it makes sense to discuss trade issues separately with Mexico and Canada.
One more second here, guys. Where I can't find this now.
US Trade Representative Greer says the USMCA trade agreement could be exited, revised, or renegotiated. All those things are on the table.
First thing I'm going to read to you is from Citadel or Shitadel Securities. Didn't be
Voice
saying
news
that.
disconnected.
We're reading their stuff. Noshad Shah put this out recently. He wrote, stocks and bonds remain heavily levered to the U.S. Oh, let me post this stuff inside the Discord for you. Stocks and bonds remain heavily leveraged to the U.S. monetary policy outlook, something which I mentioned in this note last week. December's Fed meeting will be one of the most contentious in some time, but it looks like Chair Powell will eke out another rate cut despite significant reservations from a substantial portion of the FOMC. In keeping with consensus-building approach that has defined much of his tenure, looking forward, the key question will be the extent to which guidance from next week's meeting will endorse the ongoing normalization of policy rates currently discounted by markets in 2026, a further 60 BPS of cuts. Should the FOMC deliver a hawkish cut, as I expect, it will likely do so through an SEP, which sees only 1 or 0 further adjustments to the policy rate next year, and a shift in the language of the statement. Currently, the statement reads, quote, in considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks, end quote. In December 2024, when the Fed delivered the last of its adjustment cuts before pausing for 9 months, it changed the statement to, quote, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, I'd expect similar language this time around and would highlight the many parallels with the December 2024 meeting, which saw a final cut delivered alongside hawkish guidance. Whilst the market expected further rate cuts, XPX sold off 3% during the hawkish presser. As a matter of fact, if we were to sell off right around 3% right now, that puts us at roughly that 650 target down on the weekly trigger. This is clearly a risk this time, too. That's from Noshad Shah at Citadel Securities. The next thing that I'm going to read to you here, though, is something counter to what Citadel is saying. It's also counter to the narrative. We're going to discuss a cut. And the arguments for a cut. We know that the White House policy, and as well as the Hassett and Moran and a few other policy mavericks from this White House, are making the arguments for not only cuts today, but more cuts, right? Just start cutting, basically, right? And we also know that the information that's being parlayed in public is not only inaccurate, but blatantly so. There's another argument here, too, for just cuts. We like cuts. Market likes cuts. And that the data is demanding these cuts, and also that we don't have data. So I want to refer you to a few stories here that I've been reading. The first one is going to be from the NAR says, I'm just going to highlight this to you. But the NAR says that typical first home buyer age was 40 in 2025. That was a huge discussion last week on socials and in the media. And this was a major media too. Wall Street Journal, New York Times, Bloomberg. It was picked up pretty much by everybody that the age is raised to 40. That housing is a problem for the youth. I was reading on Reddit News this morning a post about the FOMC rate decision today, and I went into the comments of the post discussing the FOMC rate decision, and my face was blown off that the top posted comments were saying that if we get a rate cut today, that it'll help bring your mortgage rates down. And it showed me these comments had lots of votes, like upvotes. Mortgage rates are coming down. We're going to cut rates. We're going to help out our fellow man. And I was shocked at how much low information your Bob on Main Street has, and that idea that we cut rates now that the long end are going to come down. We've already witnessed this past couple weeks that is not the case, right? And we've noticed this the last time we had a hawkish cut, that rates increased, the long end increased that time as well. So I want you to keep that in consideration. The October cut, the long end went higher, not lower. And that's the bond market telling you, no, we need to tighten, not cut. And then this NAR article here is the same idea, that we're being fed information that's not quite accurate. Another one I'll point your attention to would be college-age students. are unemployable right now. And if you look on the Fed website, you'll see that it's in the natural trend. Not like the little squiggles on a 1 month, 3 month basis, week to week, month to month is not trend. You can create trends over 3 or 6 months, but it is not trend. And that narrative was pushed around recently as well. But I want to talk to you about a few things here. I want to talk to you about 2 articles in particular. I want to highlight a few things that a couple articles that Wolf had posted. First one was, in edgy bond market, 30-year treasury yield hits 3-month high. 10-year yield hits 1-month high. Mortgage rates jump. The expected rate cut gets complicated. A dovish Fed amid rising inflation can spook the bond market. The treasury market and the mortgage market with it has gotten a little ruffled since the tranquility of Thanksgiving week ended, despite the widespread assumption that the Fed will deliver another rate cut this week. The 30-year Treasury yield has risen by 17 basis points since the day before Thanksgiving, including 2 basis points today. Now, this article was from the 8th, and it's gone up since then, too, right? The 30-year risen by 17 basis points since the day of Thanksgiving, including 2 basis points today, to 4.81%, the highest since September 4th. Since the rate cut in October, the 30-year yield has risen by 26 BPs since the first rate cut in September last year. It has risen by 87 basis points. The effective federal funds rate, an unsecured overnight rate at which banks lend to each other and which the Fed targets with its monetary policy rates, has been drifting up ever so slightly after each rate cut. I want to draw your attention to this chart here in the bottom right-hand side over here, that we've been cutting and cutting and cutting and cutting. And the bond market here, that the 30-year yield has been saying no to this. Wrong way. We're loosening too soon. You can just take a peek at that if you want. The 10-year treasury yield briefly jumped nearly 6 basis points this morning, just to hear from 4.20, but then edged back and closed at 4.17, up 3 basis points from Friday, and up 17 basis points from the day before Thanksgiving, and the highest close since November 5th. The Fed's short-term policy rates and hopes for rate cuts have only limited impact. Listen to this closely. For those of you out there that don't understand a lot about rates, this is something that you need to know. The Fed's short-term policy rates and hopes for rate cuts have only limited, remember that, limited impact on the long end of the bond market, where yields are largely driven by fears of future inflation and fears of an onslaught of new supply of treasuries that the market has to absorb by pulling in more investors, potentially with more attractive, thereby higher yields, meaning lower prices for existing bondholders. The inflation scenario is made worse if the market sees prospects of a lax Fed in the face of inflation. The Fed, at its interest rate decision on Wednesday, will have to make do without much of the current data that is still tangled up in the after effects of the government shutdown, including inflation and labor market data. Markets now expect a hawkish cut with several dissents and a hawkish tone of the dot plot depicting participants' projections for rates, inflation, unemployment, and economic growth. The Fed may also provide more details on its balance sheet. In addition, the market has to digest 6 Treasury bill auctions this week. Not only that, we have more data coming out in the coming days into next week. Today was already busy with 3 auctions. The 3-year, $85 billion mortgage rates got pushed up by rising long-term Treasury yields. The daily measure of the 30-year mortgage rate by Mortgage News Daily jumped by 9 basis points. The average life of a 30-year mortgage is less than 10 years, as mortgages get paid off prematurely via refis and sales of mortgage homes. And so the mortgage market roughly tracks the 10-year yield, with mortgage rates being somewhat higher, and this spread varies over time. Let's see if I can take a peek at it this morning and see where it sits. Hold on a second here. So see where that 10-year is sitting right now. Currently on a high as of yesterday, or at 8 o'clock this morning, of 4.2. just mooning and cranking. Hasn't seen a high like this since back on September 26. And scroll through and find any of this commentary in here, and then we'll move on to the next one. So in this article, basically what you're hearing is if we start cutting now, the top line on this is that we're taking a cut at a time when there are major inflation fears that we could ramp inflation higher, and the bond market is not happy with these proposed series of cuts. And not only that, the dot plot for the future, the SEP, and the projection of cuts for the 2026, I believe, through 2028. Yeah, I want to read something else about this because I thought this was funny as well. There's a comment here that says, where does Japan fit in? The carry trade has evaporated year over year, plus 90 bips on their 10-year. They own at 13% of outstanding U.S. debt. The rates are beginning to move. They look like an indicator for the entire BIS ecosystem. Correspondingly, at some tipping point, cut versus hike does not look like a decision that can be made in the vacuum of U.S. politics. And I really did like Jerome's take, or not Jerome, excuse me, Wolf's take on this. He said Japan has 3.0% inflation. The 10-year yield is only 1.97%. So a negative real 10-year yield of negative 1.03. It should be 4+%, given where inflation is. What does that mean? You guys know what that means? The BOJ's main policy rate of 0.5%. With 3% inflation, the yen has collapsed against the dollar, impoverishing Japanese people when it comes to imports, energy, foods, and other stuff, and international travel. Their monetary policy has been totally effed for decades. For decades. I mean, like, the idea that Japan is going to suddenly change their monetary policy is quite absurd here. Absolutely absurd. But I've got something else here for you. We just discussed inflation, and we want to talk briefly about jobs. We don't have the full unemployment data. I do have some information on that from ADP, but it's not as bad as people think. And before I even read this, I want to highlight to you that the unemployment rate, it used to be full employment, maximum employment, was 5%. That's what it is, 5%. And now all of a sudden it's, oh shit, the world is going to end at 4.25, 4.50. So it's almost like we're creating the narrative that we need a cut because of unemployment, when unemployment is nowhere near 5 or higher than 5. So when we're discussing the risk to inflation versus the risk to employment, it's a weak argument. It's been a weak argument, even with the light data that we have. Job openings jumped by 443,000 in 2 months. Now, I want you to think about the jobs data that's come out and what you've consumed about unemployment, jobs, that kind of stuff. And I want to read this to you so you have a firm idea about this. Job openings jumped by 443,000 in 2 months. Labor market retightens. Fed faces a scenario of solid job market and accelerating inflation. Due to the government shutdown, there is no good figure for job openings in September, and the September release was canceled. But partial data that businesses self-reported electronically were included in today's October release. This is back on December 9th. According to the Bureau of Labor Statistics, the October data was collected as normal in November. So month-to-month comparisons for October lack a solid base. September data is only partial. August was the last complete data set, 7.23 million job openings. and the August to October comparisons are valid. And that's how we'll get around the September partial data issue. You got to remember that if you miss 1 month, you got to remember that people are arguing that when you miss 1 month of data, that is trend, and it is not. And 1 month does not create a trend, nor does 3 months. 3 months to 6 months, you can start creating a trend. So I want you to consider here that we're making decisions at this meeting based upon 1 month of missing data, right? I want you to think about this as we move forward. So you get a cut today of 25 basis points. And then if you get some information saying that the unemployment and jobs markets in the next week or two are actually healthy, there can be what? Inflation fears, right? And we also have inflation data coming to the table as well in this next week. So it'll be interesting to see if you get the cut and then the data is fully against a cut at this meeting. I'd also let you know that when you go from a hawkish to a dovish cut, I want you to also think about why we're cutting, when we cut. I want you to think about that as we move forward today and the data that comes out for the rest of this week. If you're, I want you to think about the idea that, I don't know, like a top line kind of an idea here. If we're cutting for a few different reasons, or a couple different reasons, right? We're cutting into the expectation that the economy is going to deteriorate. Are we cutting thinking that employment will deteriorate? We're cutting because we think GDP will deteriorate. We're cutting because we're heading into disinflation, right? Recession, right? Is that happening right now? So that's the big question, right? And the next question is Moran talks about wanting, and we also have the idea of the new Fed chair and new regime change. We have this whole argument of dropping rates down to fully zero, right? And when you if any of you out there read Moran's manifesto, he glossed over the risk to markets. In theory, what he says in his manifesto sounds great, but it's never been run. So that opens the door to QE, doesn't it? Would require QE, right? We cut this, or negative rates, maybe. I mean, no one wants to talk about that, right? Negative rates, or if we get stuck in a bind, right? It would be one of those two things if his theory is incorrect. And the bond market is uneasy about this too, right? Job openings jumped by 443,000 in October from August, seasonally adjusted to 7.67 million. That October total of 7.67 million jobs was the highest since May, the second highest all year, and up year over year by 55,000 openings. That doesn't sound horrible. The 3-month average jumped by 154,000 openings. Average of increases in August. I also want to show you something else here if I can. I want to show what I mean here about trend. And these are job opening trends here, and you can see that we're in what's called the frying pan pattern, right? Usually when you have breakouts or breakdowns of these trends, they take more than a month. They'll take like 3 months, 6 months. Either way, right? They tend to take time to create a break to go down. And by the way, this is a year. This is 2019 to 2020. And you have an argument going on right now that we have a deteriorating unemployment situation going on in our markets. And, the argument is it's 1 month. Or 2, and then all of a sudden we have to cut right now. It seems kind of weird to me. All data here are from a survey of 21,000 companies. Some of the data were electronically self-reported by companies, and some of the data were obtained via survey methods. The data here are not based on online job postings. Job postings are largely results of quits, layoffs, and discharges, and other separations. Now, you've also heard another argument, haven't you? That layoffs are huge. But yet we have more job openings net on year and a lot more job openings of late. Go over here and just move this over for you here. Just park this. There you guys, that right there. So job openings are largely a result of quits, layoffs, and discharges and other separations, retirements, deaths while employed, all of which are tracked by today's job openings and labor market turnover survey, JOLTS. Only a small portion of these 7.6 million openings represent newly created jobs. Quits fell by 150,000 in October. From August to 2.94 million workers who quit their jobs voluntarily, such as to take a better job somewhere else. The 3-month average fell by 75,000 to 3.05 million quits. Fewer quits means fewer job openings left behind and less hiring needed to fill those newly left behind job openings. The survey tracks turnover in the labor market. How many workers quit voluntarily to work somewhere else? How many were discharged for whatever reason? How many retired or died while employed? And how many were hired to fill these left behind job openings? Turnover in the labor market had exploded in 2021 and 2022 during the labor shortages. That episode of massive churn was expensive and inefficient for employers, but ended up reshuffling where people worked with better matches between workers' skill sets and aspirations and companies' needs. I do want you to know that if our unemployment situation is not deteriorating and we begin to see inflation ramp, we've discussed this before, what is the best thing for you to do? Number one, you should secure some kind of rent as soon as you possibly can. If you're a renter out there, you should maybe think about moving now. If inflation begins to ramp, you want to start doing what? You want to start looking for a new job. You want to start looking for a new job, and you want to start asking for more money to keep up with this anticipated inflation. And that's what we did in 2021 and 2022. I made a post on Twitter this morning at 6 a.m. that showed a McDonald's worker for $28 per hour. And that post was in reference to the inflation ramp that we experienced post-COVID. And there was anecdotal evidence that people had that they weren't keeping up. Well, smart people looked for a job for $20, $30 per hour. Now, I want you to think about that. When you're thinking about the bottom 10%, the top 15%, and then the middle, I want you to think about, in simple terms, why everyone hates inflation so much right now. And it's easy to simplify. If you had a worker that worked at McDonald's, this is one of the worst jobs you can have. It really is. I mean, I know the argument that if you stick it out, you can be making six figures as a restaurant manager, but most of you are not going to do that. You got to understand that pre-COVID, bottom of the rung worker made like $10 per hour. And now you have a bottom of the rung worker being paid $28. I don't want you to think to yourself, are you making $28 per hour? And if you're not, why not? And if the bottom of the barrel worker is making $28 an hour, they have a right to be upset. They go post-COVID. This is what, 2019, 2020, 2021. And they're getting $30 per hour. So I'm making 10 and then I'm making 30. And why is my quality of life not improving? It also begs the question for your mid-tier worker. Are you making $50 and $60 per hour? If you were making 20 or 30 pre-COVID, are you now making that much money? 50, 60. So if you're not, if you're making this bottom of the rung's making 30 and you're making 30, or even if you're making 50 or 60, your life is probably better, but you're not seeing what it could be, are you? your pre-COVID, pre-inflation spike, you go from 30 to 60 an hour, your life should improve drastically, right? So there's anger from all sides, and yet we want to cut, right? For what? The stock market? Which is fine. I'm just wondering. We might be going back to that again. We never change the rate of that. We start to ramp inflation again. Do you want to see a McDonald's worker making 40, 50? I think that's plausible. I think that's absolutely plausible. So they'll come for your money, right? And you'll have cheapness in the stock market. What's the net result, though? Stock market should go up, shouldn't it? Stock market will be cheaper. And that'll all serve an administration. I don't know where cleanup on aisle 7 comes in on this. I'm wondering where we clean this up later down the road. Do we start going to where your bottom of the barrel rent is like $3,000, $2,000, $3,000, something like that? And the wealth effect where you feel like you're wealthier, but you actually are not. Layoffs and discharges rose by 129,000 in October from August to 1.85 million. In the middle of the pre-pandemic range, the 3-month average rose to 1.79 million, the highest since November 24, but still at the lower portion of the pre-pandemic range. These relatively low layoffs and discharges, though up from the era of labor shortages, have been confirmed by other data, including very low unemployment insurance claims. Why are there very low unemployment insurance claims? Because people are finding jobs. They're available. Let me show this to you real quick. I want to show you the argument that's going on here right now. This is 2015. I'm going to mute this for just a minute here. This is, if you follow my cursor over here, this is 2015. This is the norm. And this is the norm. Actually, the norm is higher. The norm is up here. And we're coming back into the norm. I want you to think about that. We're coming back into the norm. How low are the layoffs and discharges in relationship to non-farm payrolls, which have grown over the years? 3-month average of grown over the years with a question mark. 3-month average of layoffs and discharges amounted to just 1.1% of non-farm payrolls, which would have been a record low before the pandemic. In the JOLTS data, which goes back to 2001, these relatively low layoffs and discharges translates into fewer job openings, which are already high, and less hiring to fill those job openings. So I want you to think about that too. I want you to think about the idea that we have slightly higher layoffs, but we also have higher job openings. We have low requests for unemployment insurance. It means that people are finding jobs. Hires rose by 23,000 in October from August to 5.149 million. Hold on, I got to go back to this bottom right. Bring this back here. Apologize. Bring that chat box back. Excuse me. The 3-month average declined by 113,000 to 5.21 million hires, roughly where it had been in August, after the spurt of hiring earlier this year. Most of these hires replaced workers who'd quit their jobs or who were discharged or laid off for whatever reasons and who'd hired, etc. Only a small portion were hired to fill newly created jobs. It's part of the labor turnover. But the low number of quits and the relatively low number of layoffs and discharges means that companies need to hire fewer people to fill the job openings left behind, and job seekers are having a harder time finding a slot. The retirement waves are over too. Other separations, retirements, deaths while employed totaled 255,000 in October at the very low end of a 25-year range. The 12-month average, which irons out the huge month-to-month squiggles and shows the trends, inched down to 305,000 for October. These monthly totals are compared to 7.5 million job openings. There had been a wave of retirements in 2021 and another in 2023 through early 2024, but they weren't extraordinarily big. The main thing to take away, listen to this closely here. The main thing to take away from this job openings and labor market turnover survey is that the labor market is in pretty good shape. That's not what I'm being told. That's not the narrative that's being pushed around. I'm also being told nobody can buy houses. That's false, too. And that the average age is higher than it's ever been. That's a false as well. Actually, millennials are buying houses on pace better than prior generations, believe it or not. But low turnover makes it harder for job seekers to find a job. Listen to that. So listen closely here. So people, the squeaky wheel gets the grease, right? The antidotal is where we are today with our news. We're not looking at the data anymore, are we? What we do today is we go on to FinTwit, we go on to Twitter, X, we go on to BlueSky, we go on to Truth Social, we go on to Reddit, and we read comments. Or we get sizzle pushed on us. Sound bites, headlines. We don't even know who's writing these articles anymore, do we? We don't even take the time today to check basic facts in news articles. You know what else I read a lot today? A lot of news today here. Implied, thinking, maybe, possibly, inferring, but never citing actual data or data that you can look up. Or you see that the data is a month, a week. There's no context. And we know that this has always been a problem with data, with statistics. But by the time we're getting done with telephone today, we're reading anecdotal evidence and calling it real. So what is the reason for that anecdotal evidence being so prominent? One, you have the selling of sizzle. And then two, you have some people that are having issues. They really are, and they're upset about it. You know, the rate of inflation that is given to us, when you're out and about, you see that it's not real, right? Or it might not be real for you. Or you're constantly running from place to place trying to beat it. Whether it's a restaurant or it's I shop at Walmart, now I shop at Aldi, and then I shop at this place. You're constantly ducking, dodging, and weaving. You have other things out there against you as well today, don't you? Dynamic pricing, right? You can't deny that some things are expensive, can you? You're getting paid more money. The rate of inflation still goes up even though it's leveled, right? It hasn't come back down into disinflation. Some of you haven't switched jobs yet. And here's what I'm getting at with that. We had people that jumped jobs, and now they're not jumping jobs. The main thing to take away from this job openings and labor market turnover survey is that the labor market is in pretty good shape, with a sharp increase of job openings in October, while the red-hot turnover in the labor market in 21 and 22 is cooled, with companies hanging on to their workers and workers hanging on to their jobs, creating a situation that requires less hiring. But low turnover makes it harder for job seekers to find a job. So you've got most people are working today, but the person that is not may not find what they want for work, or they don't want to switch careers, or they don't want to relearn a new skill set. You got to remember, I don't do this for a living. I started doing this post-COVID. I had to learn an entire new skill set. This involves back-end production, front-end production, speaking on camera, public speaking, for hours on end. I've never done that in my entire life. And I learned a new skill set, didn't I? But low turnover makes it harder for job seekers to find a job. Each time someone quits a job opening is created that needs to be filled, and the company needs to either promote someone into that job, which creates a lower level job opening, or hire someone from outside for that job. When there are lots of quits, it creates more opportunities for job seekers to slide into one of those left behind job openings. Now there is less movement in the labor markets and therefore less hiring. And people looking for a job are having a harder time finding a slot. And other data has confirmed this trend. And what does that lead to? That leads to what? People complaining. Or maybe there aren't job openings in your field. Or maybe your field is going away. Do I want to work in Bangman, or do I want to work in nuclear power? Or do I really want to go back and work in coal or gas? You know, I don't want to do that, but you know what I mean? I have to retrain for a new job. Not an easy decision. So I get angry and I go on and I say, I'm angry now. And someone wants to sell you information that is you're reading everywhere. So I'm reading that everybody's angry about not being able to get a job. So I'm going to write myself a story and post it about how awful the labor market is. There's layoffs over here. Unemployment is bad. You can look at all these people are saying it. And this also placates the anecdotal worker who can't find a job, right? They're like, look, it's awful out there. They just don't tell you that. What? Everyone else has got a job. Everyone else is working. Everyone else is consuming. Right? Or maybe you don't want to take that shitty McDonald's job for $30 an hour. Or maybe you don't want to go work in this new field that's opening up because of whatever reason that you don't like that industry. I want to go back into Fangman. I want to go get paid to sit in my office and make fucking $600,000 a year. And I can go into the Meta office and work out all day long, eat free food, eat this and that. So the labor market's not as bad as you would think. And 1 month of data does not create a trend. And you can extrapolate some data from that missing data. And you can look on prior months. And there's no chart out there. None. Maybe COVID. We're the only one that I've seen where it's been like this, vertical. Or vertical down. Are we in some kind of a moment like that right now? No. So a lot of what's being spun out there, whether it's Citadel, whether it's GS, where it's JPM, when we come into these meetings like today, you'll tend to get the real data. And I want you to listen for that today from Jerome Powell. When you're thinking about that hawkish or dovish cut, he tends not to tell you the bullshit sizzle. And I expect him to say these things today. So I want you to look today to see if he does address these things or not. Because the narrative today is that the unemployment situation is deteriorating. And that is not the case. Right? I'm reading it to you right now. So you've got that narrative being spun everywhere. I'm interested to hear him say that or not. Unemployment's bad. Jobs are bad. Or maybe there's information we don't know. Or maybe there will be contra data that slaps that right in the fucking face. I mean, if you've got Jerome coming out today saying labor market's deteriorating, and we get new data in the next week or two that's contra to that, we're going to have some trouble. All for a narrative for a trade. That's why I always say there's the actual rates and then there's the trade. The trade and the actual rate are completely different. Completely, like the actual rates and then the trading of we're getting a cut, we're not getting a cut, We're getting a hawkish cut, a dovish cut, and they're independent of each other. Did I have that one tagged off over there for 2 p.m.? Nope. We want to make sure we keep track of this here. Just trading sideways right now. Push that up for you here. Not doing too much. Here's one of these commenters posted a question. He said, can we be sure that the government has not double counted some current job openings by adding in partial September data with full October data? Wolf's response to this was no. Of all the problems that the data might have, double counting is not one of them. The survey, a mix of electronically self-reported data by companies and surveys sent to companies, establishes the total number of job openings in the current month. So October in today's data, 7.67 million. That figure is, that is the figure, and my charts show that figure above in this article. Then to get month-to-month and year-over-year changes on 3-month average or whatever, I subtract a past month, such as October, from the current month. Out comes the change. The month-to-month change is also in the press release, and it's obviously the same as my month-to-month calculations because the whole data set is based on total job openings each month, not changes from month to month. So the September total was an estimate by the BLS based on a partial data set. So it's a data point in my chart, but it's not usable for an October total minus September total month-to-month figure. But October total minus August total is based on 2 complete data sets. So there cannot be any double counting. I'm going to post both of these for you in the Discord. And this is kind of contrary to what I've been reading. And the reason I wanted to read you Wolf's stuff first is because of the second thing I want to read to you. This is the important part. I'll cut and paste this inside the Discord for you, but I want to read this to you read some of the highlights of this this next article. So now contextually, I want you've got the top line take from Citadel, you've got the top line take from Wolf, and then I want to read to you the zeitgeist. FOMC preview. What is the bigger risk? A hawkish cut or a dovish cut? It's not even a question of if we get a cut or not, right? Because once we get to that consensus, we get closer to that consensus, historically, in recent memory, the Fed has not been adversarial. They used to be, but not in recent history, have they? They don't want to scare or spook the market as we get closer and closer to FOMC. The Fed is widely expected to cut rates by 25 basis points to 3.5, 3.75, with Fed money markets currently pricing in a 90% chance of such an outcome. And this comes despite widening divisions amongst policymakers, with many dissents expected Wednesday by both hawks and doves. The latest cut would follow October's reduction, bringing the total of 175 BPS in rate cuts since the easing cycle started in September 2024. Although Chair Powell cautioned then that a December cut was far from assured and gave an analogy that driving in the fog, you could slow down. As Newsquawk wrote, given the government shutdown, key data has been delayed, and little has been seen since the prior meeting. But in the following week, we will see the October and November NFP and the November unemployment rate and the November CPI. They follow a September-October JOLTS report, which came in far stronger than expected. Although markets are heavily pricing in a cut, it is a close call as shown by expected votes. And given this, there is a widely held view that it will be a hawkish cut. Now, just listen to what I read to you there. 1 month of data does not form a trend, up or down. Whether that data comes in hot or cold still does not form a trend. So some of this is kind of garbage. And you've got the Pikachu face on the jobs data coming in strong. And they were already strong. So you've got two different arguments going on right now, right? The argument for cut, no cut, and it's all about 1 month of data. None of the data says we should be cutting. At the last meeting, Jerome said we might not have a cut this December. But what is a hawkish cut then? It means that the market is pricing under 8 BPS of cuts in January and less than a full 25 in the first 3 meetings of 2026. So you've got the argument for a cut today. 25 basis points priced in. None of the data over time looks like we deserve a cut, and we have more cuts scheduled in future months. So the market is pricing under 8 PPS in cuts in January and less than a full 25 in the first 3 meetings of 26, after which Powell's term as chair ends. And that's the next thing here. We already know that Moran and Hassett wants 0 rates, right? B of A's interpretation is that investors have anchored to the notion that a mid-cycle adjustment usually entails 3 cuts. JPM adds that one way this could be conveyed would be for the statement to mimic last year's forward guide. Last November's statement referenced in considering additional adjustments. So just remember that part when he's speaking today or when the presser comes out, which is followed by a cut in December. And then the December statement was adjusted to say, in considering the extent and timing of additional adjustments. The key words here is in considering additional adjustments and in considering the extent and timing of additional adjustments. So the tone and speech or the verbiage today are going to matter for these future cuts, which was followed by a pause in rates until September 2025 by reverting to the extent and timing guidance. The committee could hint at a pause in the coming January meeting. So I want you to think about this as we move forward today. If you get your cut and then you get some more hawkish tone, a change in, maybe you're not getting that cut, those future cuts. And maybe that unemployment data is not so great. I mean, excuse me, not so bad. That unemployment data is not so bad. And probably risk a little bit of heightened inflation after this cut. And we're pricing those cuts in right now. That's how we go lower. There is one more thing in here, and that is the Fed chair. And that's why we have the argument of the shadow chair. You're getting your cuts. Don't worry about it, bro. As soon as we get Jay Powell out of there, we're going to slam him 150 BPS. If he doesn't give you the cuts in January, by mid-spring, we'll get him to you one way or another. JPM adds that one way this could be conveyed would be the statement to mimic last year's forward guide. So you want to look for that verbiage change today if we get that hawkish tone. And this is interesting as well. Incidentally, Chief JPM economist Michael Ferroli expects the statement or the post-meeting presser to be hawkish. However, he expects the weakening labor data will lead to a January cut. Markets are pricing in less than 30% of a January cut. The data doesn't agree with that statement. The data that we have does not agree to a cut in January due to weakening labor market. It just does not agree right now. Looking ahead, Rabobank expects the Fed to continue its cutting cycle at least until its estimate of the neutral rate is reached. Hawks versus Doves. In the October FOMC press conference, Chair Powell noted that there are strongly differing views on how to proceed, and that another cut in December is far from assured given inflation risks. Powell added that October's cut was another risk management move. But going forward, it will be different. When speaking on the lack of data at the time, he said he could imagine that the lack of data affects the December decision and gave an analogy that driving in the fog could slow you down. Despite the clear ambiguity from the chair, it isn't widely felt across the committee. And economists' calls for further reductions have been underpinned by backing from several Fed officials, including key remarks from New York Fed President Williams, who said that a near-term cut could be appropriate. As far as who's on board the cuts, News Squawk analysts have indicated that among the voting members, 4 have explicitly supported cuts: Bowman, Waller, Moran, and Williams. 1 is seen as leaning towards a cut. Cook. 2 have been unclear. That's Powell and Jefferson. While 5 are leaning towards a hold. So no matter what the vote is today, the FOMC committee, they're kind of 50-50 at the moment. Even if that doesn't come out and how they vote, from at least what they've said publicly, they're about right around 50-50. And those people that are, the 5 that are leaning towards the hold are Barr, Schmidt, Collins, Muslim, and Goolsby. Divisions mean the meeting could produce the highest number of dissidents since the early 1990s, with 4 or more opposing any reduction. Polymarket has the odds of 4 dissenting votes at 22%. You could probably take that bet and win, and could even end in a 3-way split: dissent to opposite decision, the decision, and a 50 PPS cut for Moran. You could actually see a 3-way split in today's decision. The Powell presser at the press conference, Rabobank thinks Powell will probably downplay any dissent as something that follows from a challenging situation with upside inflation risk and downside employment risk. Regarding the January meeting, the chair is likely to stress that the Fed is data dependent and makes decisions meeting by meeting, but any clear signal Powell provides would be key. When he spoke about December not being a foregone conclusion in October, a strong hawkish reaction was seen at the time. Bank of America is more skeptical and says that Powell is facing the most divided committee in recent memory. Therefore, he will attempt to balance the expected rate cuts with a hawkish stance at the presser. So you get the idea here, right? You'll get your cut. There's no data, assuage the market. But then on the flip side of this, they probably know that the cut is not deserved, and that the data will come out stating that the unemployment and employment numbers are actually still in line, just as he did in October. But the bank is skeptical he can get away from an interpretation of data dependence. Powell's hawkish remarks in July and October jolted markets, but they don't seem to have changed the policy path. Investors may be wary of getting head faked for a third time, especially because we'll be getting so much data before the January meeting. The week after the December meeting, we'll get October and November payrolls, the U rates for November, October retail sales, and the November CPI, which should get more iteration of all of these indicators in January, possibly for 2 retail sales before the FOMC meeting. And then there is the fact that Powell is a lame duck, and his replacement is coming out in just 5 months, if not sooner. So the idea here is that even if you're going to get the hawkish commentary, potentially from J. Powell today, a 25 BPS cut, does it really matter if you don't get your cuts in the early part of the upcoming year? You're going to get those cuts whether J. Powell does them or not, at least by May, if not sooner, if there's a breakdown between the White House and the Fed, as Trump tries to assert authority over the Fed. So how can Powell credibly signal a pause in January? He probably will get a question in this vein. So if you get like Powell coming out being hawkish, I would expect a reporter to say, does it even matter? Like, even if you're going to pause, bro, your replacement is going to give the cuts that we want, so why not just give the cut? Why play hawk? Or are you just trying to extend this out? Is the economy actually fine? Is the unemployment rate actually fine? One option would be to indicate that it would take significant further weakening in the Labor Department for the Fed to cut again. Investors will be looking for any indication of thresholds for the January policy decision. Powell won't commit to quantitative thresholds, but he might provide qualitative guidance. Another option for Powell would be to argue that the policy rate of 3.5 to 3.75 isn't restrictive in real terms, with inflation, even the example of tariffs, still a few tenths above target. While B of A is very sympathetic to this argument, they doubt that Powell will want to take such a strong stand, given his general dovish leaning. On bank expectations, Goldman Sachs says that we will get a 25 basis point cut today in line with market expectations. You'll have 2 dissents in favor to keep the rates on hold and no dissent in favor of a 50 BPS cut. They'll adjust language back to 2024 language to reflect somewhat higher bar. Focus will be on how Chair Powell positions bar for future cuts. So watch the language closely. They will likely say that they want to see how the data unfolds over Q1 to softly indicate they want to take stock over a longer time frame. On the dot plot, the focus is on the UER forecast for 2026. Expect the median dots for the Fed funds rate to be unchanged. One further cut in 2026. One way to display a hawkish cut is to show higher UER and still holding one cut, indicating the expectation for labor market weakness. Now trading higher into 683.96. Powell won't give up optionality fully and will say that they are looking at things meeting by meeting. Showing a higher UER with same number of cuts indicates that there needs to be more progress made on inflation. And here, and JPM is next. They're saying 25 basis point cuts in line with expectations and at least 2 dissents. So a little bit more hawkish in the dissenters than GS. They expect the statements or the post-meeting presser to be hawkish. However, weakening labor data will lead to a January cut. Markets are pricing less than 30% of a January cut. Medium dots will indicate only one more cut in each of the next 2 years. No change to GDP unemployment. Some chance of inflation is marked down a tick or 2. Market reaction. According to Goldman FICC trader Sean Titia, the bank's client consensus into meeting is, listen to this closely, the trading community, as we have gotten numerous inbounds on worries around the FOMC derailing a year-end rally, Titia writes that broad-based index SPX is likely fine, even in a hawkish FOMC. The more hawkish that Powell sounds, an example being the more he emphasizes being close to neutral, labor market data being okay, etc., the more likely the market will probably try to trade NDX greater than RTY and other similar rotations under the surface. However, even if SPX is unlikely to sell off meaningfully after the event, an extremely hawkish FOMC will place a lot of importance on the payrolls that will come after. The setup into this FOMC meeting is very different than into December 2024 and this past October. A few notable differences that stand out is that there has been a sizable correction in some of the frothier equities since mid-October. You should consider that we have literally taken a buzzsaw to single stickers, haven't we? December 2024 and October 2025 were hawkish surprises. This is clearly not going to be a surprise given the entire trading community expects hawkishness today. I'd actually argue that the risk is that there could be a low-quality rally into what is perceived as less hawkish than feared rhetoric. And any extra hawkishness can likely be quelled in the coming weeks by an announcement or the anticipation of an announcement of the new Fed chair. The market seems to continue to positively decay into the new committee in May. Tutia concludes that many clients believe that the front end of the rates curve offers convexity, with a little more than 2 cuts priced for 2026, and the fact that we'll get 5 months worth of payrolls data by the March FOMC. So he's saying basically rear view mirror this shit. He's saying you'll be lucky if you get a trade to 76. We already traded a low of 82. What is that? $5, $6 away, right? 4, 5, 6. $6 away from this morning's low. And we traded down into this event. So maybe there is an upside trap here. And even if we were going to trade the 76, it might be after today. Or maybe it's in the presser, but not the press release. And I'll show you that back on the chart here in a minute. Tahia concludes that many clients believe the front end of the rates curve offers convexity with a little more than 2 cuts priced for 26. And the fact that we'll get 5 more months worth of payroll data by March FOMC, there's a growing belief that the Jan-March tenors are ones where people think there is value being long and receiving. The variant perception, while the prevailing tail risk scenario, according to consensus, is one of an extremely hawkish sounding statement, Powell presser, always the contrarian Michael Harnett takes the other side and writes in his latest Flow show, quote, that the only thing that can stop the Santa Claus rally is dovish Fed cut causing a sell-off in the long end. In other words, Harnett believes that an overly dovish FOMC will send the long end yields surging, similar to what happened after the jumbo September 24th rate cut, and spark a sell-off in equities as the next inflation wave is priced in. In summary, the Goldman head trader thinks it's hard to get an extreme broad market reaction to the anticipated hawkish FOMC. As such, he thinks that owning optionality into next week's payrolls is more valuable. For those of you in the Discord, I'm going to send you the white papers on this in the next few moments. And what does that mean over here? We have the no stopping going up here. So their idea is if this is already known, maybe the move is upside today. So instead of this dog leg down, you get your first leg down here. Whoop. That instead, we're ripping it up here. Maybe come back for this later. Potentially get some more hawkish tone in the presser. Hit that first target. Hawkish tone. Whipsaw up once all that data comes out. I'm going to leave this one up here for that 2 p.m. Actually, let's switch over to this one here. Let's take a look at this right here together. Just coming back into this here, we had this high. We satisfied what we needed. We do have a bull flag. And we did sell down into today, a binary event. Right now, we're trading up, looking for some kind of a breakout to the upside. Remember that these binary events are hard to predict. I do have this one over here. What I'm going to do is I'm going to leave this here, change this to dotted. Come back to the 1 minute. Bring you back to the main screen. I'm going to move this one over now. This is 2 p.m. $2:30. We'll talk about this. 2:30. Right up there. I'm going to start pushing that one up here. We'll leave this open here. We're actually going to talk about some of this too. I want you to also note, if you don't know anything about FOMC, there's a few things I do want you to know in here. And that would be the dealer's juice options. If you have upside targets here, 690 is right in here. I also want you to remember that we have a prior high here. And I want you to, if you haven't ever done this before, there's a few things I want you to realize in here. And we get things like this, start ripping or whatever, right? We'll tend to like reset the options chain, right? Reset the options chain, right? Reset the options chain. Should show this better. Same on downside moves. Oftentimes for these binary events, you'll just miss targets. Just miss a target. Just miss a target. Just miss it. Oh, wait a minute. Just miss a target. Reset. Hit a target. Oh, just miss it. Reset again. So I want you to think about that too. You could be directionally right and your trades are upside down. Another thing about these trades is you want the safest trade. You'll typically, if you want the safest trade, you'll typically look for the dip. Wait for the dip, right? And if all's good, the data's good, we can buy that. If the data's bad, we will step aside and for new lows. So you come down like this, and you don't see that new low to buy. None the worse if we start blasting down to the downside. For a lot of you too, even if we go up here, let's say we go to the upside, this will oftentimes revert a day or two later. So you still get an opportunity to buy the dip and go up again. Another note on these things, spreads can be your friend. And also, I would say to do not get cut up. So let's say we're in here at 2 p.m. Say you're getting long calls. You're like, hey, I'm long calls here. And you see a little blast down, then whip up. You just stay in your position until you catch a print. If you were getting cut up in here, and it goes to the depths of hell, you're still going to lose that trade anyways. So you might as well stay committed in your trade if you're early in what you're trying to do. Same applies on downside moves. It's usually better to stay in your position until you get print. The only thing I would say to you is on this, let's say you got a call here or a put. You got a put or a call. Let's say they cost 50 cents. Doesn't matter what you have. And let's say you've got a call. And it blasts down to 10 cents. then you cut your losses, and then it ramps up to $1. Be mad at yourself, right? Let's say it goes to $2. These events get crazy, right? My thing when I trade these zero dates, what I'll do, let's say I bought this for 50 cents, and let's say I bought the call. I'll pick $1. I try to stay in this middle zone here. Let's say my call is going to 10 cents. Oh, I'm on fire. If they're going to burn, the dead trade anyways, right? So what you can do is go in here and you go to 10 cents, just leave it on. Let's say we get to $1, take my money, and then it goes to 2. Woo. I'm happy with the $1. You know, sometimes when I put that, if I don't put that market, and if I'm going to hold it, definitely sell in a market order up here. Limit orders tend not to fill for a lot of you. Sometimes they do, sometimes they don't, depending on who you are. But a lot of traders find that market orders are better if they're going to hold. For me, oftentimes we'll get in and out. I preset a limit sell for the upside. Blow by it, take the money and run. If it goes down to 0 and we end the day, and I hold these fucking things right into close. 4:15. Goes to 0, I don't care. Maybe we ramp up at the end of the day. Another thing about today is I want you to remember that there's going to be 2 different portions to this. Some of you already know this, but at 2 p.m. you're going to get the actual press release. We'll have a news squawker in real time read the changes to you, how hawkish or dovish is the Fed today. And then we'll also get a press conference a half an hour later. You'll get to 2 different trades there. You're going to get 1 trade or 3 trades. You're going to get the early part of the day today trade. I call it like the Harlem Globetrotters, layups and stuff like that, back and forth, back and forth. If the market begins to run away to the upside, you'll see the press release come in, a ramp or a dump, and then you'll have a second. Hold on 1 second. I'll be right back. I just heard a loud noise. You'll get 2 separate trades in here. So you get 1 trade. You get 1 trade here, 2 trades, 3 trades. Oftentimes you'll see, like, say we're trading up or down into the first. So you got first trade right here. Like, oh yeah, we're gonna run away with this, bro. Then all of a sudden, boom, down, then up. You know what I'm saying? Dump this thing down again, and then the presser starts back up again, then back down again. So you've got like 1 trade here, a 2nd trade here, 3rd trade here, and then you have a 4th trade, which is end of day. Oftentimes, even if we're up on highs, you'll see selling towards the profit-taking end of the day. If we sell here today into the depths of hell, we'll oftentimes stay down into the close and have continuation for 1 to 3 days. I don't know why this doesn't happen on the upside, but I'm sure it's profit-taking of some kind, but typically I take the money and run at the end of the day. And I don't rarely see continuation. We'll actually sometimes come back and sweep those put lows a day or 2 later, 2 or 3 sessions later. Then the market will unwind and head higher. And we also have coming up a bunch of data that we don't have. We have expiration ahead of us, and we have QuapX coming ahead of us. And a potential unwind to 7,000 at month end and after post-QuapX, post-expiration, post-DivX. It's 11:36. Give me just a few minutes here to take a break. I'm going to drink some water. I'm going to go potty. Shouldn't say that in public, like a child. But I'm also going to post inside the Discord some key white papers on today's expectations and the hot takes from the street and all the participants for you, including retail traders. Leave this right here for you. And I'll be right back.
Wall Street Journal reports that Jeff Bezos' Blue Origin has had a team working for more than a year now on the technology needed for an orbital AI data center. We have posted the Wall Street Journal article on the feed for those interested. Ukraine say that drones hit the Russian Shadow Fleet tanker in the Black Sea. So the previously mentioned Shadow Fleet tanker attacked by Ukrainian Navy drones is disabled as a result of the attack, according to SBU sources.
You had a school day? What, for the snow and the ice and the rain and all that stuff? Well, you lucky girl. You're so lucky. Turn that off. We got a school day today. I saw you this morning, didn't go to school, and I was wondering if it was just listen to my voice. It's terrible. What is this? Ezio Corp? I said this really quick. Azio Corp unveils Azio AI, an independent high-performance computing company following rapid expansion, sales pipeline first 60 days. We gotta click on this and see Control F. Robotics. Oh, wait a minute. I don't see robotics. This one here. So Reddit's breaking out, Hinge is breaking out. I'd still like to see a dump in here. 1:30, 2 p.m. I'd still like to see like one more flush. I'd like to see like something. I'd like to see some kind of a fake out here. Like touch this and then blast down a little bit and then up. Keep this one here. I'll just check where it's on the morning low down here. That really quick there. It was on Tuesday, right? That over there. I'm gonna check the hour real quick too in the 4. Hour still says down. There is a 4-hour down here we need to watch. we didn't break this one yet. This one still hasn't been broken. This one has been broken. Get rid of that one. Have my daughter's home this morning. We've been getting hammered with snow. We have like the El Ninos now in Nina here. Like Michigan's been very dry and warm the past 5 or 7 years. And this year, the weather patterns have changed. So we're supposed to get like an old school Michigan winter, which is lots of snow, tons of snow, and cold. We've been getting hammered with snow here. We got an ice storm today. We had snow, a couple days of snow, and now an ice storm. Got the guys outside working, and we're doing ice melt and stuff so it doesn't all freeze. I got like 6 inches of water in my street with about to freeze. Take that one out. We just need to take these two out right here, and then this one right here. Hourly velocity is improving slightly right now. And I'm also all this snow. Keep thinking. I've been running around. Like I've been really busy. Like when it's Christmas, it's like or holidays or Thanksgiving is nice. I'm actually grateful that I didn't go anywhere this Thanksgiving. Once I get into this like Christmas stuff, it's like nonstop. It's like gotta go here, gotta go there, gotta go this, do that, wrap up the year, do that, this, that, all these other things. It's like busy. I actually don't like Christmas anymore. I don't like the time period, like from now into I want to say New Year's. I'm not really a fan of it anymore. I mean, I like the things that you get to do, but it encompasses a lot of other people and not me. So I'm like, do this for this person, do that for that person, do this for this and that, and all that kind of stuff. So I thought to myself yesterday, I just talked to Doggone It about it. I was like I was gonna go skiing for Sundance. So I can get skiing in locally, but I haven't taken any time for myself. Just a weekend. So I was like, I want to go to the beach. And I was like, Palm Desert is nice and calm. It's quiet. It's old school, like California, old people. It's just like really calm. They have these nice little like double-story resorts with like a pool, and you sit around and you have a cocktail and you eat healthy food and shit. But I was just talking to Doggone It, and I was like, well, I'm just gonna flight too on like a Friday and go to like Miami and come back on Sunday. And then the cool part about Miami is like quicker, and it's quicker, and you can watch out for this one right here. Get a high, lower high. See a little bit of a dip down in here, and then back up again, just like we've been doing all day. Up, down, burn the chain. So you got Miami is like easy. Miami is like off the plane, sitting in like the Fontainebleau or something, and you can like sit in the pool, get dinner at Nobu, be dancing in your hotel room, sleeping. Then you do that for like 2 nights, and you just chill. It's cheap and easy. So I'm like, maybe I'll just ski local, and then the other thing too is like, if you go skiing, it's like I'm gonna go on a ski trip this year. Some of the best times to go to like SLC is probably the easiest place to ski. It's the easiest place to fly into. The best ski. Well, if you want like everything's a trade off. SLC is probably the easiest place to fly into with the most amount of mountains. It's like a 20 to 45-minute drive depending on how fast you drive the canyon. Like the city is close. Like Colorado's destination, you got to bring people. It's like a week, 2 weeks. It's like one mountain. You might be able to drive to another mountain, depending on where you go. Like you can go to like Copper or something, and There's a few mountains around there, but not like Park City. And the cool part about Park City is if you go like peak season, if you go during Sundance, especially so Sundance is 2 weeks, but the first week is the busiest time of Sundance. So if you go that first week, no one's skiing, like nobody. All the hotels are full. No one skis. Everyone's focused on Sundance. So if you go during Sundance, you can ski all day long and hammer good powder. It's close to the city. It's easy. Like fly in, drive up there, and you just pound in snow all day long. So that's when I prefer to go there. So I think I might do that. I think it's like February 19th or something. Maybe do a quick trip to Miami and then a trip to Sundance, and then I think I'm going with the A106 boys to A106Z or something. I don't know what those guys are. What is that thing called? A106? Oh, look that up. A16Z. Yeah. We're going to go to this other thing. I was supposed to go to this last year and didn't go. I got to talk to who? 80. Because they have that future proof is when future proof is right around when Ultra is too, right? Isn't like when's Ultra? Ultra is March 27th to the 29th, but I want to go to Future Proof. I can't be gone that long because the Future Proof is the 16th to the 19th. When is Future Proof this year? When is it this year, though? It says it's March 8th through 11th this year, so it's not near. It's actually even farther away than Ultra. That sucks. I think I'd rather go to Future Proof. We're at Future Proof's in Miami, yeah. So no Ultra this year, but Future Proof. That TNX coming down right now. I got to decide what I'm doing. Do you guys notice that Bitcoin's on the daily trigger? I'm afraid it's going to plunge and then go up. I'm afraid it's going to. So I own a Bitcoin. It's on a 3 trigger cluster right now to squeeze balls off on this cut, as long as it's not super hawkish. What's going on over here? Is this going to dump yet or what? We're going to grind this and then dump it? Higher high, lower high, lower, 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 low. Are we going to squeeze and fake? Let's see what I got here. So today on the Fed rate decision, we get the FOMC economic projections along with, because the end of the quarter for Q4. We also get interest rate projections for second, third year. That's the 28. We also get the current and longer. The presser's at 2:30. Tomorrow morning we get balance of trade, exports, imports, and then initial claims. Those are coming in pretty light right now, so I'm not expecting too much of a surprise there. Tuesday is the key. I bet we return to a low on Tuesday for NFP and unemployment. I think those are going to come in just fine. I wonder about with the cut. What does that mean? The bigger one is December 18th. That's Thursday. So you have volatility centered around expiration on Wednesday. So you'll see fear into, like, you get the cut today, and then you're going to see the fear needing to be priced into CPI. CPI should come in slightly hot. CPI is going to start. We're gonna ramp CPI here in the next coming 6 months, in my view, into next spring, summer. We could have a pretty, if we price that in like January, February, we could go moon, like full moon. If they start pricing in whether it's Jerome that does the cuts or the new Fed chair, market will go fucking moon. Not for anything positive. You want me to talk Oracle earnings? We could do that. You want to do an interlude and do some Oracle earnings? We can do that. Give me a quick second here. I'll bring it up right now. We're going to do Oracle earnings. Someone asked about it yesterday, I think. Here's Oracle. Let's take a peek at Oracle. So you've got Oracle earnings. Look at it. Their next expiry is, I believe, for their options, December 15th. No. Oracle shanked into their ER. There is something to talk about here. Oracle is theoretically in risk off right now. You see that daily trigger crossing that weekly trigger. Last time we had that happen, they had a rejection. You can see it right here. Rejection across, then they were let up to go. Right here, so you can see it. There's Pikachu face here, right? Let's take a look at this last example here. We had the rejection right here. They did get a bump off their last ER in here. Here's their earnings. This was March. They had a surprise report. They had a beat and a miss. So back here, they had a miss. They cranked, then sold down again. At the time, they were still in a downtrend. Downtrend in monthly. But that was also the signs of a bottom. In this case right here, you have some higher highs here. No negative on a weekly basis. Still kind of close to the same. There is some accumulation on monthly. That's good to see. There's some accumulation going on. They have a pretty big expected move here, 9.5%. Let's go see real quick. Oh, this is on their next report. So the daily here is recovering to the upside. Whoop, like this. But maybe still that down and then up. So what we'll do is we'll look at what the 9% expected move is here. For where we are right now at this moment, our 10% expected move into the next their next expiry. 241.65. So right up there. Then on the downstroke, they've got 197.08. So I would say that just by looking at this, I would say that the puts are not priced in. Even if you go up here, I bet you take that trade right there, and then we're up, something like this. And not only that, but this is when I talked to you about the like if you go up today, you're probably going to get one more downstroke in the market. So if we go up today, let's say you go up, you could still get this downstroke in here. And I don't think the put side's priced in. What we want to be looking at here is what do they need to do here? So the big thing here is this. So I just want to show you this here. You've got, before we do anything else, what's going on over here? Let me just reset this for a minute. I don't know what's going on. Doesn't matter. I would. What is going on? What is like going on here? Hold on 1 second here. One quick second here. That's ironic. I'll say there. Can I move this over here or no? I can do the same thing. Okay, we're good. Let's just look at this briefly here. I got to do this on a different layout, so hold on here. I go back and talk about this again. 240.41. The current price. Downside expected move 198.10. It's the option market's pricing in over here. God damn. Hold on here. Just look at this. There's a gap that needs closed down here. You can see it. Get some gappage down there. And you got a whole bunch of gappage down here that needs filled in. There's probably some expectation that you're going to take this all this out at some point. You also have an inverse, cup and handle here. Kind of see it. And come up here, take out that high, swing back down, and then up. I don't know if you get this deep. SPY pushing higher now. The daily, let's go to the daily really quick again. It's in accumulation, I can tell you that. Unlike this last period, it's in accumulation, which is good to see. On a 30-minute basis, it's in accumulation, but the hourly looks like shit. That doesn't look good to me. You already had a high up here. Though there is a monster squeeze here in their last earnings. Monster squeeze. It is an accumulation, but if you're looking for that same thing, it would be like September. Something just like this right here, just moonshot. There's no expectation of that in this ER. Let me look at their prior. Let me look at that September. It doesn't show their expected move in here. They made a 35.9% move in September. Let me show you this too. If you look over here on this right-hand side, down move. December 11th, 23, down move. December, they stayed in trend. And they did have an up new move in 2021, a big one. They do tend to stay in trend. If you're watching this closely, you can kind of see they do tend to mark bottoms if it can go up. This is a pretty big down move here. It's a good analogy. It would be June 13. If they stay in trend in history, just looking at this, let me go to let's go earlier. Let's look at a month here. Let's just look at this technically. So you got this big supply down, right? Murder bots. What you want to be looking at here is, watch this close. Well, let's look at a 3-month candle first. Let's start at the 3-month. So, this candle here erased this one. This one is not erased yet. So we want to switch this to like a 1. We'll come back and say that's an expected move. We want to put this one in right here. This is the important one for Oracle. It's a big one. What makes this important here is you start blasting through this stuff here, it's like party on time. We're not there yet, so on a 1-month basis, let's take a look at it on a 1 month. I can tell you right now, you're not in. Oh, you are. You're in value right now. You're in value down here. Anything down here you should be buying. This is all value. That's good to know. This is your monthly right here. So I got some good news for you. If you're a lover of Oracle, This is good value. Even if you don't have a payout today, you're in the place where you want to be buying it. The start of it, at least. You're coming into take money profit at 222.54. That's important to know. Your target's 240. So you would see profit taking, theoretically. On a weekly basis, there's a couple cool things here. You do want to be buying like 190, 160, anything at $100 be buying. Because it's time to accumulate, I can tell you that for sure. On a weekly basis, you are in a down move right now. You need to know that. You're still in taking profit, but you're not on the. You're still in a good position here. So you want to be buying like buy that. This has already been bought, but same thing over here. And the other one is we'll go back to the month again because there's one more target. You're in buy mode for sure right now. Just a matter of how deep of a discount do you get. This stock actually looks better than a lot of others that have gone through their ERs. Look at this on a 4-hour. So we can snip this here in a minute, but right off the top, I can tell you this. If at any point you see, I'm going to give you some numbers here. If you see 190.37, 154.11, or 129.06, you want to be buying these. You want to be accumulating down here. The accumulation's already begun, and you might get another chance. So the expected moves are in here. And you have some gaps to close down here too. You're quite supportive right now on this upside. And you want to remember this prior high right here. See this prior high? Like all it needs to do is literally like bust this one out. This expected move. Sweep back down here and then back up again. And I'll be honest with you, I'd like to see that last one down there. Some range expansion going on down here. You can see one right here, one right there, shoot it up, maybe sweep one more. And this could be like your January. Let me look at this real quick. It's like a bigger time frame here. But just so you can see that there. And then on a 1-hour basis, let me go back to the 4 real quick. It's all intraday. This is all going to be buying. Let me check this really quick here. I'd love to see that sweep up in here. To buy that. I don't think you get the sell-off until go all the way down there if you want. Up here, I'm pretty bullish here. Maybe stall that out right there. Stall this out, print the call side. Print the put side, print the call side. You got one more down. You got something coming here. You got something coming in here. And I see this too in the whole market. I see it. Check something over here. I want to see where this all started. Let's just check where this starts. So like this started over here. And you can see it over here. These guys are going to come back in over here. This is getting kind of big here. Like come in here and like this is where the buyers are, but I think you flush all this out. I think you're gonna like hit this one right here. And then you get the release. Part of a larger pattern. 1, 2, 3, 4. And then they finally cut you out here. It's something like this. Up, down, down, down. And I see this too. I want you to know that whatever role we have, it's going to be more like this last February, March than the economy is breaking. And this will also force some of that or be anticipated in some of that, like rate cuts for no fucking reason. You're going to buy that one, and you're going to buy that one. Now, what about all this up here? The problem you got up here is you're going to have these sellers up here. These guys are waiting to unload. So it's hard to explain this. So, move that over slightly. I like the idea of popping up here. Then catching that supply. Down, 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 up, down, then up. So it radiates more like this. I like the up move here. And you're beating that high. Right? You're down up here. Matter of fact, this one's probably pretty good. So you got 1, 2, 3, 4, 5. Maybe squeezing into the ear. 1, 2, 3, 4, and then 5 up here. And then you do the blast down here. We'll fix this later at the bottom because I gotta. So you can see it down there. Whammo. So you've got like 1, 2, 3, 4, 5, and you got more supply coming in. You see it now, maybe? There's the December 29th. This is sometime in January. And I don't know if this goes all the way up or not. It's up here. This is gonna be a disaster in here. It's gonna be a bloodbath. This is what I see. Now you still got to hit this thing down here too. I can't tell if you're going to go that deep. you know, no one looks at the wicks, you know. So you got something like that. I'm just putting the dotted lines aren't like we're definitely going there. It's just you could, you know, this would be a wick. Dotted lines are more like wicks. So if these are more like wicks, then this is more like this. Here's your 5 right here. 1, beat this. This should hold here, but it can extend all the way down there, believe it or not. This is your 2. Now this should be your 2 and this should be your 3, but we're going to be conservative here. The other problem with this is if this is not a 1, 2, 3, 4, 5, it could be 1, 2, 3, like a straight shot, like 2 squeezes, and that's your double correction. Then you'd have a 1 down move up here, and then there's your, this would be 5 actually, 1, 2, 3, 4, 5. 5 waves. I could redraw this if you really wanted me to. Could be something like this. 1, 2, 3. We don't know where this ends. Break the base, right? Nope. Don't break that high. That's gonna be a fucking bloodbath. Yeah, did I get that right? Something like that. It's gonna be a doozy. Could be gnarly down there. It makes a little bit more sense. 1, 2, 3 up here, and then bam. One, 2, 3. Oh, there's your 3 right there. Or your 5. It's up actually. It's not that far. It's not that bad. Because you're going to beat that low right there. Then you're going to beat that low right there. Then you're going to go right down here for your 5th wave. So I think happens. 1, big, big, big. And they're going to want to, don't hesitate. This is going to happen, I think. If you're in, even when you're in distribution and so you're in like this distribution accumulation, you know, you got like people who want to sell up here, take profit, take profit, take profit, take profit, but it doesn't matter because they're still going to be buying this. Like they're on both ends of this trade. You can see it. You know, big swoop from here, right? Big swoop down here, wham, buy it again, and then it's off and running again. And you'll get some more of this stuff over here. See this cluster right here? They'll take this profit too. They'll do this again right over here. And they'll take more profit and then sell it down. So pretty bullish here coming into Oracle. You might swipe this one down here. This is the expected move. And then this is the expected move down here. I still think we have a little bit of this in here. This might even happen quicker. This would be the Monday the 22nd right here. Substroke, nail that one, blast it back down on bullshit fair, and then get the juice flowing again. Then we're cranking up into the end of the year. I'd expect them to make a large move up here into the end of the year. January, Feb. Price target 286.97. ultimately by late winter. 286.97. That's the big boy up there. Lower end target 251 on them. You're going to still be in distribution, but it's going to get bought the entire way. You want to post this for you somewhere so you can see it? If you're an Oracle fan, something like this, and you can kind of see it over here too, right down there. I don't know when that is, but maybe something like this. Let's spend more time on it, but I don't have the time right now. We're going into FOMC. That shit's going to crater. Kind of see it now. Switch right through there. Remember, I'm doing this in like 5 minutes. Squeezing higher now. Staying on track. Just note that as we get closer, they could do a dump in here. So you can see it. So they're washing their hands of Oracle on highs, and then whenever you get a new low, I've got the 3 targets for you to add on that ticker. It should resolve into a monster move. And it kind of matches up here to your rate cuts, whether that's Jerome or a new Fed chair, whether the economy is failing or not. I just got a phone call. I was talking to a buddy of mine about
ECB's McClough says that I'm confident medium-term inflation will be at 2%.
I was just talking to a buddy of mine about another part of the interplay of rate cuts. So you see like you see the topical arguments for like, or the topical you know, like, how do I explain this? I mean, simplify this for people. So you know, sometimes you have a savvy child, or
ECB's McClough speaking in Dublin.
So my children, right, when they're young, normally between like 9 and 12, but 9 years old, they start thinking for themselves, being a little bit more independent, and they make a lot of mistakes. It's a time period where they learn how to lie. And, you know, lying's a bad thing, right? But people lie. They lie to cope oftentimes. They lie to get things. And it's kind of comical when your child's lying to you because they don't know that they're lying. So you can either punish your child, or you can explain to them what they're doing, and explain when it's good and when it's bad. And that you know that they're always going to lie. If you ever speak to like a police officer, if you ever known a police officer or someone in authority, especially like an investigator or something, they'll point out how much you actually lie. It's an easy way to interrogate people. If you've ever been an interrogator of any kind, what you can do is you can catch them in lies quickly. People say, I never do this, I never do that, I never commit felonies, never commit misdemeanors. And then they'll ask you a series of questions, and you'll be like, fuck, I do that. God damn it, I do that too.
So ahead of the
the intent
interest
of
rate
that is
decision for the
to-
Federal Reserve, where we get the expected forecast is for a 25 base point cut.
Voice
That-
news disconnected.
That technique is meant to make you feel like you're guilty. Okay? So, when you're with a child, you're explaining them, when you're trying to get something, sometimes you tell little white lies, right? Or you emphasize something like, I really need this, daddy, or mommy, or uncle, unk. You just can't say that anymore if you're 18 years old. You have to explain to them that people do that. You'll tell white little lies, right? How are you today? I'm doing great. And you're like, I'm having the worst day ever. That's a lie, right? So there's different ways that humans use lies. So when I'm looking at whenever I'm told something, I'm always trying to think about what's the real reason. It's not always nefarious. Sometimes it's nefarious, sometimes not. Sometimes it's to drive to something else. So I was just on a phone call earlier about just showing this Oracle stuff. And this Oracle stuff kind of matches up with a down move in early year, something violent. And you don't always know why. If the economy is good, and if unemployment's not so bad, inflation's not raging yet, what could it be that sends us there? And why do we want rate cuts or QE? Or why would we set ourselves up for something bad to require QE or negative rates? Why are we going to zero? I can't find the answer. I keep thinking about it. And, what I keep looking at is the fucking AI robotics race. I just keep circling back to it. Like when I look at Panama or threats with Greenland or Canada or Mexico or Venezuela, I'm like, really, fentanyl? That's such a fucking, sorry for swearing, but it's such a bullshit reason. And then I hear other people out there say it's because Trump wants to get rich or this, that, and the other thing. They just don't. It just doesn't jive. You can get rich along the way. You can get rid of the fentanyl along the way, or try, or whatever, even if you fail. But what's the real reason? Probably something larger. Usually is. So there's nothing ever nefarious. And so when I'm watching like this year in particular, China's trying to fight its way out of a recession right now, and have been doing that for the past year. And I still come back to China. Still come back to you have a race that's going on for new technology, and when you're in that race, some governments can do it quicker than others. If you're in a dictatorship, you have you've got like everybody's raising their hands, voting the same shit that the leader's doing. They can print their way into making these things happen. And our country is not set up like that, is it? But if you can find a way to match that spend within our form of government, like a family or children have, family with kids, like a child might lie, tell you it's for this or that or the other thing, and maybe you catch them or whatever. Or maybe you catch a friend in a white lie, or they're lying to you, but it's okay, right? Or it's for the means to an end that's important to that person or that thing, some other thing, right? So whenever I'm thinking about this, like, why are we going to zero rates, or why are we talking about this, and why would we want to continue to spend? Why would we want QE? There are massive QE in these instances. We just tested it out, didn't we? With COVID. We tested out a lot of things in COVID. We tested out shortages, like we went to war. How did we react to shortages? It's like a test run. And I'm thinking to myself, well, if you need to spend like they're spending and compete like they're spending, you can't get it done. You can kind of set that up. You don't have a lot of time between now and then, right? 28, 26, 28. You could create a reason. You create a reason to put, Monroe Doctrine and Roosevelt Doctrine back into South America, Central America. Start breaking old alliances. We've been doing that, right? Have you noticed we're breaking alliances? Those are alliances that fit a post-World War II governments, right? And if you even remember in World War II and World War I, we would fuck that up post-World War I, and then World War II, we didn't fuck it up as much. And those alliances served that post-war environment. If you remember, even Churchill, we didn't come to his aid until the last possible moment, did we? He was on his back feet, right? If you remember history, it's like, well, we'll do this for you if you do this for us. And even post-war, those alliances served that post-war period. And now we're coming into new technology and potentially new forms of government. And we don't have those new forms of government to service that new technology. So then if you don't have it, maybe you have to work towards it, or it's going to take time to, or you have to work around it. So you tell little white lies to service that, that race that's going on. So and even from that, when you see like Oracle going down, or I've got Oracle going down next year at some point, is it because of anything bad? Probably not. They want to be able to kick in that money. You know what I mean? And there's some profit taking in here too with Oracle. So I think Oracle's going to go to Moon and stuff like that. But just note that as we move forward, you'll see this in the review for next year. If we're going to enter the bubble, if we break out the playbooks, maybe it's sideways with some major lows and then some ramping. Or we ramp the beginning of this year like we did in 95, 96, come back down, and you have some stocks that get lows and stuff. We start ramping again. We need the money flowing to service this new technology. So if you've got the wealthiest people in the country saying, I'll give you all my money to service this, and you get the government on board doing the same thing, you can meet that demand without being a dictatorship, in quasi-socialist or communist, I should say, government. You can do that yourself in a representative democracy while you try to decide what governments are going to service this new economy, and this build-out that's going on. So when I see just looking at today at this FOMC meeting, I think this is just another step in the machine moving forward. Fucking wild. I don't know if they're successful or not. I don't know if it all blows up and, AI is all bullshit and general AI and super AI is bullshit and robotics never really takes off, but they're doing it. You can look. You don't need me to tell you this. You can just go to Google. You can go to the Fred. You can look at manufacturing building builds. It's vertical, up. Hasn't been like that in a long time. And it's been going on now. And the decision making to make those decisions to do that spend, we haven't seen. Machinery building on the Fred for manufacturing, vertical. And the decision making that goes on to get to that point is years ago, decade ago, if not longer. And you imagine the meetings that took place and the decisions being made, and then servicing that with different presidents and regimes. For us, the plebs, I hate that guy. I want someone different. Okay, put him in. Same shit's going on. We'll take the guy I hate again for another period of time. Until I hate him, and then we'll smooth it out again. But it's all still this machine that's moving forward. Until it either fails or I think this is bigger than I think this is bigger than other grandiose thoughts we have. You can see the machine moving in the background. I think young people see it clear as day. I think older people tend to stick their heads in the sand or think it's not going to happen. But if you think about the 1830s through, the difference in how we fought war in in the early 1900s in World War I or later 1930s and 40s, just the way we waged war, the changes that took place into TVs in your living room, electric, gas, all this other stuff, and machinery and labor and manufacturing. It just you couldn't recognize it. If you're someone that had one foot in mid 1800s to early 1900s, there's no way it was anywhere close to the same thing. You've got interstate systems being built across the U.S. and dirt roads that couldn't connect you to the West. You didn't even have dirt roads, right? 1830s, 50s. So, and you could have one foot in both of those time periods. And just imagine being that older person, 80, 90 years old, and unrecognizable, literally unrecognizable. Cluster here, 4 trigger cluster, 1 5 minutes, half hour, hourly. Watch out for a quick dip here as we come into 2 p.m. We will have an in real time news squawker, so it's not delayed like the 15 minutes you get with Financial Juice. We will also have the press conference live on this show at 2:30 p.m. Be aware that if you get excited or upset today with the outcome, that we have a lot of volatility still coming after this in data that's rolling out and also in quarterly functions. We've got data down the pipeline, a ton of it. And then we also still have DivX. We've got Vixpiration. We've got QuapX. And then we've got month end. So if you don't find the dip that you want, you're probably going to get at least one more chance to get that dip. December is historically known as a volatile month, even though it becomes green. There was a moment a few weeks ago where some of our traders felt as though they were being caught in some doom. And that feeling can continue in December. So let's say you're putting on a spread. You can put some more time on it. January OPEX, February OPEX, March OPEX. Even if you catch the print in January or December, you can exit early. If you see a bloodbath at any moment, today, next week, or whatever in December, you're like, I didn't get the best positioning. It ain't going to matter. You're still going to catch your print. So just remember that there's volatility and you can be shaken out of your bullish upside calls. I don't see a path lower here. I see a path lower, but I don't see a path lower of doom. Where you don't come back up here and hit the 700. Our top expectations into end of the year is, I believe, 715. I think that's like for December, end of December, January, March, like near 720. I will warn you, though, whenever we're going up there to whatever that is, that 715 or 720, I'm pretty fucking bearish thereafter. I mean, like, bearish. My like full bear suit, when we're up there, it comes out. I think Oracle here kind of expresses that for you. Now, will there be an early like gotcha moment or something? I don't know. I just know that whenever that roll happens, you better be ready to do it because we're really fucking close. If you look on higher frame velocity, like weekly, monthly, quarterly, it's topping out. So there's going to be a moment. I don't know if it's in March or January, February, but there's going to be a moment. Now, there's a couple ways we can work that out. We can either do a flat correction through a year. We can do a sharp correction like we did in February to April. We were in that same place last February. So I want you to consider that as we move forward. It was dealt with differently in the 90s. We had flat correction, and then we had a bunch of crashes within a year candle for the late stage of that. Now, I don't know if that doesn't take place until 26, 27, 28. And I don't know if all this AI robotics thing and machine learning, I don't know that stuff. Nobody does. But if I'm looking at the playbook, it looks to me like we're in 95, 96, not 99. I don't see that. The second part of this bubble has not happened in my viewpoint. There's like a bubble within a bubble within a bubble. There should be like 2 bubbles like this, and then a middle part. And I think we're coming into the middle part right now, and then one more big part of that bubble. And I would be using, as if I had to guess, I know that Mike Barry claimed that he made a very distinct point that OpenAI was Netscape. I disagree. I think OpenAI is closer to Amazon. Maybe it's Google. Google could be that Amazon, but I'm unsure about that at this point. And the only reason I give Google an edge is because you all have fucking Google with Gemini. Gemini is in everything you're doing as of right now. It's tracking everything you do, all your emails, all your pictures and cameras and videos. It's listening to you. It's listening to you on your phone and your computers at home. I wouldn't doubt it if it's monitoring on all of your computers right now. I wouldn't be doubting that at all. That would be the edge that Google has, that you have it on everything. It's everywhere. It's pervasive. So it's the only edge I give to Google, but otherwise, OpenAI. It's probably that Amazon type company. So whenever they launch that, I would be aware of whenever that IPOs. That's probably the start of the next big bubble. You want to watch when they're going to IPO that very carefully, so that they catch the second half of that bubble, in my opinion. So I would run that company's IPO just like Amazon. And Amazon was late to the party. There was early pre-internet companies, and then I remember specifically, I was an early adopter of Amazon, and there was always a discussion of why have they not IPO'd? Why have they not IPO'd? Why have they not IPO'd? And they were a late comer, and they survived. So I don't know if that, maybe it's like rhymes or walks and smells and talks and sings like a duck. Maybe it doesn't survive like Amazon did. But I would be running that playbook if I was OpenAI, most certainly. Even if they don't survive and they meet the Mike Barry fate of Netscape or whatever. If I was from OpenAI, I would be running that same playbook as Amazon. Watch for the quick dip in here. I'm going to start to remove this kind of stuff in here. We don't really need this kind of clutter. Just remember at home, the half an hours are like an hour, 2:30, 3:30, 4:30. I'm going to turn the news squawker back on. Thank you for joining us today. If you don't mind, this is one of the biggest days for us each time we have an FOMC meeting. If you wouldn't mind reposting a link to this stream on your favorite, wherever you watch it. We stream this on 4 different platforms. It gets restreamed on blogs. It gets restreamed in Europe. We have people in Discords that ask to restream. People contact me. If you're watching me in one of those other places, if you wouldn't mind on your whatever social media you have, Instagram, I don't know, Threads, Facebook, Twitter, StockTwits, wherever you are. This show is free. It's on every day. So I'd really appreciate that. You could like and subscribe. I'm going to open up the chats right now, whatever I can.
So White House Economic Advisor Hassett currently speaking on Fox News.
If you're on YouTube, watching on YouTube, or want to watch on YouTube and comment,
Hassett says 25 base point cut would be a small step in the right direction.
We're going to open up the commentary.
And the Fed will probably need to do some more.
So you just subscribe. It's free. You can chat. If you're on Twitch. If you're on Twitch. I don't know how to do it on Twitter. Twitter, I think I have to go to Twitter and do it. It only gives you the option early. On Twitch, if you want to chat, Mr. Bezos, I think, is still doing this. You can go to Amazon Prime and subscribe there. And you can chat for free that way. I don't know if that's still valid right now, or maybe if a moderator or an admin's watching. Bork, if you're watching, if you have any way to get in the back end and try to open up the chat on Twitch, I'd appreciate it. You can watch us. We're on all kinds of different platforms. So I really appreciate it if you could like and subscribe today while we watch the FOMC decision. If you get left behind here, that's okay.
Hasid has a lot of
calls,
negotiations to get to 25%.
I always wait. If I get left behind, I get left behind. But if we get to see a nice drop in here, something nice kind of drop, you want to buy 0-day calls, wait. If you're a bear today, I still have us going down. Technically, we should go down today. We should trade 76.
As it says, a stronger data could support 50 basis
not
point
lower.
cut.
So just be aware of that from like a technical Elliott wave and ICT perspective. We should dump down trade like 676. I'll show it to you here. Let's go back and look at this really quick. So I'll show you from a technical perspective what we should trade. We should trade down into this 677.12 is what I've got right down in here. So just be aware of that. The street is saying there should be a blow off first of volatility. We might have already had that, but there's a lot of people out there that think we can trade 690.
As it says,
but we could blast down in here, then trade,
even
trade
more,
like 685, reset, then 690, and then come down and trade the 676. What else do I got here for you? Go back and look at this together. Right down in there. Just so you can see it, this is the prior high.
So again, to reiterate, Hasid
remember,
said
6,900.
a strong showcase of data.
There's literally nothing stopping price right now from a gamma perspective. From us just fucking squeezing balls up here. You take the money and leave. If you're looking for the safest trade, I'm going to let you know that sitting on your hands today, if you got a small account, if you have a small account, there is
Ford supplies receive China's new rare earth
white line down here, the 681.14.
Seeing WTI futures flip to gain after trading down.
If you see a blast that breaks through here, I would not be trying to buy that dip to go up. I would be waiting to see any kind of thing like this, down, down, down. I would not trust that. I would expect a continuation. If we do recover here, yeah, you could probably take that up and jump on that. And I will be verbally talking to you if I'm available, if I can see what to be looking at or what to be doing. What else? Here's some of the weakness I was talking about as we head into 2 p.m. And I will also have on the screens down below here in the background, I will have a split screen, and I'll be watching the 10-year, and I'll be watching Dixie, and I'm not going to have it on the screen for you here. I really want to watch this gamma support and resistance, and I think you probably do too. But I'm going to be watching in the background here the reaction to all three HYG, 10-year, and the DIX. If you have a small account, don't be trading today. It's that easy. There's no point. There are easier trades out there for you. I might pop these up on the screen for you to look at them in a moment. I'll try to verbally tell you. Currently at 30 years at 4.78 right now. It had a high at one point of 5.153. Bond market not happy at all.
Hassa says Trump is to make final Fed chair choice next week, in the next week or two.
Yeah, I got two. Yeah.
That concludes Hassett's comments on Fox News.
Here's the yield 4.75, 4.16 in the 10. I'm actually going to do 4 of them here, not 3. I want to do the Dix too. There's the Dix. H by G. I want to line on the US 30. I don't want candles though in this one. TNX has come down a little bit to 4.79 from a high of 512. 10 years dropped slightly from 421 to 416. Dollar index flat right now at 98.93. HYG Hold on, I got some stuff I gotta do here. HYG spiking right now. Remember, you want to be paying closer attention to the 10-year. For the real rate. I'm also going to do one more chart over here. I'm going to watch VIX 9-day here. I'm going to move this over here maybe. There we go, right there. And down here, this is going to be the VIX. VIX 9-day. $1:33, half an hour until we get the report. I will also post inside the Discord. We could do this another way too. We'll switch later on to the layout for the Fed presser. VIX starting to climb right now. A little bit of weakness before the release. Let me just check. I'm going to write this down at home. We'll put up a notepad at home. I'm going to read a few things to you before we get started here. I'm going to give you some data that's very important to the start of this. SPX, 1-date gamma. We have a gamma pin at 68.10. That is, can you see this on this? You see that green bar down there? You see that green bar right here? There's a downside gamma pin on 68.10. This is for 1-date gamma. On the upside, there's a gamma pin above at 68.60.
According to iMoneyNet, US money market fund assets up 17.44 billion
above
for the
that,
week
there's
ending
more
December
gamma
9th.
at 68.65, 68.70, 68.75, 68.80. Top of the market would be 6,900. Bottom of the market on right now, it's looking like 68.10. If you wanted like a little bit more, maybe 6,800. Right now, there's no gamma on 1-date down below, so just it looks like the pin is
JP
above
Morgan
the
and Shell
6,900.
says everyone is expecting a 25 basis point cut.
Volume right now, 2-date on SPX. Whew, all over the place. We've got the straddle is in force right now. We've got 65.35 puts. 66.36. On the upper end, we've got 7,060, 70.35, and 69.85. It looks like, though, we're going to trade 68.50 to 6,900. If we go up, so the top target's probably 6,900. And then for the bottom pin would be 6,800. And then maybe a little bit of falter down to 67.40. If you look closely down here, this is 67.75. That's not really what I've got here for a prominent bar. Yeah, I've got 67.75, not as prominent right now as I thought it was, or was more prominent. Now showing up down even lower, 67.40. So I'm going to lower this bar here, right down here. So if you're looking for a low, right down in here, your gamma flip is
Even
still
more
at
with Michelle says
67.70.
a lot of
Just make sure I got
dissent
that
is a
right.
seismic shift.
For net gamma, it's moved up. It's now 6,800. So the gamma flip has come higher now. So 67.40 would be the sweep lower if 6,800 holds on a down move. I'm going to check at the money volatility really quick. Big, huge expected dump for the next 13 sessions. We should dump volatility over the next 3 sessions. Violent drop after the next 3 days. Volatility expected last into the next 3 sessions. Today's Wednesday, so we got Wednesday, Thursday, Friday volatility, dumping, and then it should ease off a ton the next 12 sessions. I'm going to check SPY really quick and see if it's farther off than SPX. We're kind of roped into 680 right now and 685, but that can change. I'll have this up in the background depending upon price action. This can change. The gamma can change and the volume can change. 2-date volume on SPY. 683 pin. 683 pin right in the middle. We're trading that 684 or 683 right now. So we are pinned in. And if I see any
Michelle
changes,
on long-term treasuries says we were in buying this morning.
In the volumes coming into the market, if I see a bunch of puts coming in, I'll let you know. A bunch of calls coming in, I'll let you know.
Michelle adds that we like yields at these levels. US seizes oil tanker off the coast of Venezuela. Seeing some movement towards the upside on WTI for the back of the headline again. US seizes oil tanker off the coast of Venezuela. Further detail into this, then US forces have intercepted and seized a sanctioned oil tanker off the coast of Venezuela, according to people familiar with the matter. Move that marks a serious escalation of tensions between the two nations. The White House didn't immediately respond to requests for comment. So state oil company Petroleras de Venezuela and Venezuela's oil and information ministries didn't immediately reply either. Michelle says, I'm not a believer it's a 100% deal with Hassett. And as we do see inflation coming down a bit.
Let's take a look over at Bookmap really quick. You can see that nice little red bar to pick up down there. Got some stink bids even lower. That band is at 67, 670, 6,700. Of the three places where your real buyers are, the old money buyers, they're at 670, 650, 662, 670, 652, 667, 676, 677, somewhere in there. I'll show this for you here on the... Go back to the main screen. You can see that little red bar down there. That's about your 676, 677. Slight bear flat or bear plane above 1 minute, crossing the 5 minute trigger. $930 low is where this green bar is.
Again, oil futures rose after reports that US seized oil tanker off the coast of Venezuela.
We talked about Netflix before, didn't we? I didn't like their guide at all. I know they had a stock split, but I don't like their guide at all. I don't even like them as a company anymore. I think they're going to go bankrupt with the rest of Hollywood. Hollywood's going to be boutique, super boutique. $15 minutes. Liquidity drying up slightly in the market. BTC parked on the 5-trigger cluster on daily velocity, hourly. Crypto tied heavily into this cut. How's my boy TGT doing over here? I see a lot of red out there. Beyond's been trying to get back up there. They did $1.60 the other day. Back up to $1.32. Not high enough for me. TGT, about like they hit 95 on the open today, and I was like, I don't know what to do here. Looks like a lot of weakness currently on spec growth, meme stocks. Couple winners right now that look like they want to break out: Hinge and Slide, SNGE and SLDE. You're looking for something else to trade right now: HNGE and SLDE. If you can catch any drops in that after this, I would watch both of those and wait for this rate decision.
JP Morgan's Michelle adds that labor market has been mixed.
I am long calls here, by the way. I got long at yesterday's close. I'm in long calls right here, even though I have us going down. I wanted to buy a bunch of puts. I wanted to buy like the 50s. They were like 10 cents. Never got an opportunity. I wanted to be higher yesterday to get them. I didn't like trading down into this event at all. I want to see the squeeze and then the roll. Looks like the JP Morgan's got a little more dour outlook on labor market. JP Morgan's Michelle saying labor market has been mixed. That's bullshit, too. Horse shit. They get Super Bear coming out. Michelle coming out, or Michael, or whoever saying not a believer. It's 100% deal with Hassett. Does it really fucking matter? We have like 2 or 3 people, at least 2 or 3 people that are lined up for that Fed roll, and that they're all parroting the same shit. So. Oh, Michelle's out here. She's getting bearish as fuck. He or she. I don't know if it's Michelle. I shouldn't be saying she. It could be a he. Let's look up Michelle. I don't know Michelle. Oh, yeah. He looks. Oh, yeah. Look at him. Global head of fixed income at JP Morgan. Ugh, gross. I'm gonna post him on FinTwit.
JP Morgan's Michelle says public credit markets look solid. Ten minutes away now from the main event, where we get the US interest rate decision. Forecast is for a 25 base point cut to 3.75% from 4%. We get the FOMC summary of economic projections and the rate statement. Fed median rate forecast for the next 3 years forecast 3.125%, unchanged from the prior. Fed median rate forecast for current is 3.625%, unchanged from the prior. Fed median rate forecast for next year unchanged at 3.375%. Fed median rate cast for the next 2 years also unchanged at 3.125%. And the Fed median rate forecast for long run is 3.125%, prior 3%. So let's just looking at some of the ranges then as well. So for the current year, the range is 4.125% to 3.625%. For the next year, the range goes to 3.875% to 2.375%. For 2 years, 3.875% high range and low end of 2.125%. Fed median forecast rate for 3 years ahead with high range of 3.625% to 2.125%. And for the long run, the range is 3.625% to 2.125%. At the same time, we get the Fed budget balance, and also Trump is due to host a round table.
Shit. Oh, man. This saying Trump's coming out today, too?
JP Morgan's Michelle says that I'm expecting bull markets into year end. So, reminder for the federal budget balance forecasts is for minus 195 billion, prior minus 284 billion.
Did you just say Trump was holding court after this? Fuck. I think he just said that. We got the fucking bond, like, we got the bond vigilantes blowing up the markets right now. You can tell that guy sits down and eats a lot of steak dinner. He looks like he's in bonds. They can stand to lose a little bit of money, those guys. Let's just see where we are with expectations. Pivot point is slightly higher. Let's just take a look and see. Where's R1 is pretty low, 684. 687 is R3. So the pivots for today is showing this as a non-event to the upside.
So just a reminder for Trump, there's no live video that we can find for the event. Usually there is. Obviously, if we do find it, we'll pop it on the feed for you.
Damn it, are those guys listening to us? Do they have the show on in the background?
Associate General's US Rate Strategy Head Rajappa says that Powell is setting the stage for next year.
Always remember, you can trade the reaction. You can sell the rips. You can buy the dips. Don't be a hero today, degenerates. How many millions do you think we can spend on zero dates right now? I got my degenerate account open right now, by the way.
Rajappa, the expectation is for a hawkish cut. So they are currently speaking on Bloomberg TV. We'll pop out the link for you.
No, we're not listening to that right now. I'll read to you what was said.
Rajappa adds that risks in environment where the Fed is biased to ease. Also, 5 minutes away now to get the rate decision forecast is for a 25 base point cut to 3.75% compared to the prior 4%. Get the FOMC summary of economic projections and the rate statement. Fed median rate forecast for the next 3 years, unchanged for the prior 3.125%. Median rate forecast for current year unchanged at 3.625%. Median rate forecast for next year unchanged at 3.375%. A median rate forecast for next 2 years unchanged at 3.125%. And then finally, the rate forecast for the long run at 3.125%, prior 3%. Rajappa adds a bias ultimately toward lower yields heading to year end.
Make this bigger, maybe? There we go. Just put this over here. And then we're going to switch formats. We'll switch formats once we do the press conference. I do just that? Nope. Nope. Oh, yeah, there we go.
U.S. Commerce Department says it will release an updated estimate of U.S. Q3 GDP on January 22nd. JP Morgan's Michelle says that the Fed will absolutely keep growing its balance sheet.
Yeah, we got some indirect QE coming in today, too. Just a heads up, too, if you don't know that out there. It's not QE, but it's liquidity to build up reserves for loans and shit. But you're going to hear people say it's QE. It's not. It is. It's liquidity. It is bank liquidity. You're going to get some of that today. They're going to discuss that.
Associate General's Rajappa says inflation may be more harder in the first half.
That means stonks go up. 3 minutes. I mean, if it was me, if I was renting a house or an apartment, I'd be fucking looking for one right now. Whatever you want to be at the next few years, and then I would be looking for a goddamn job. Start looking. You don't have to quit your job, but you want to start looking. If you're making $30 an hour out there, start looking. Start looking for 40, at least.
Societe Generale's Rajapal says the economy has been extraordinarily strong. US Commerce Department says advance release on Q4 GDP, originally set for January 29th, will be rescheduled.
I'll be honest with you guys. I wish the fuck that Jay Powell would just say, fuck you, no cuts.
1 minute ago now, we'll lead with the US interest rate decision. Remember, expectation is for a 25 base point cut to 3.75% from 4%.
It'd be fucking dope if they did that. I'll be honest with you guys. It'd be better for the market too, in my view, to be honest with you. There ain't nobody expecting that. You get that cut, man. That Fed is bought and paid for. There's no more independence.
Ten seconds. Cut, 25 base point cut, 25 base point cut to 3.75% as expected. Fed says it will begin Treasury bill purchasing on December 12th, and Fed medium projection maintains 25 base points of rate cuts in 2026. Fed says Schmidt calls the dissent in favor of no rate change. Fed will consider extent and timing of additional adjustments. Fed says it will buy $40 billion of Treasury bills in the next 30 days.
First target
coming
coming
into
right
was
now.
a downside on the Dixie.
First target being hit right now.
Treasury's
Second
holding
target
gains
above.
after the expected Fed rate cut with dissent.
Take the money off
Seeing
this
here
one
then,
right here. Take the
Fed's
money off this one right
projections
here.
apply 25 basis points of rate cuts in 2026 and another 25 basis points in 2027. Projections show wide divergence of views for appropriate path of rates in 2026 and beyond. Fed policymakers see 4.4% unemployment rate at the end of next year versus 4.4% in September projections. Policymakers see end 2026 PC inflation at 2.4% versus 2.6% in September. Core seen at 2.5% versus 2.6%. Policymakers see 2.3% GDP growth next year versus 1.8% in September, and they see longer run growth at 1.8% unchanged from September. Fed median core PCE projections at 3% in 2025 and 2.5% in 2026. So Fed median view of Fed funds rate at the end of 2025 seen a 3.6% versus unchanged from the prior. Median view Fed funds rate at the end of 2026 seen a 3.4%.
We need to go slightly higher to trade 6,900. We have not done that yet.
3.1% unchanged from the prior. And median view of Fed funds rate at the end of 2023.
6868.61 for an extension of 6,900 has not happened yet.
Official
Watch
Fed
out for the
median view of Fed
retrace.
funds rate in the longer run at 3%, unchanged from the prior as well. So all those Fed median rate forecasts coming in as expected, except the longer run, which came in at 3% compared to the lower than the expected 3.125%. US federal budget balance minus $173 billion. higher than the expected minus 195 billion.
30-year holding up right now. 10-year slightly weak. HYG
Also, the
coming
Fed
back
ends
down.
ends operational limit
Dixie's
on
still
standing
weak at the moment.
overnight
Just be calm
repo
here.
operations. And Fed says pace of future reserve management purchases likely significantly reduced. So also further from this, then the Fed are attentive to risk on both sides of dual mandate and judges the downside risks to employment have risen. Fed will begin reserve management purchases of Treasury bills beginning December 12th.
Burr money.
The Treasury bill buying to
Indirect
be
QE.
elevated for a few months. Uncertainty about the outlook remains elevated. Inflation has moved up from earlier in the year and remains somewhat elevated. Fed adds the economy has been expanding at a moderate pace, job gains have slowed, and unemployment rate has edged up. Fed signals rate cut pause by adding extent and timing to describe its approach to additional adjustments to policy rate.
Note we're parked on the pivot point.
So just to
We
tally
did
the
break
votes,
above
then,
R1.
a vote in
Next
favor of
target
policy
higher
decision was
is
9 to 3, with
686.48.
Myron preferring half percentage point cut and Goolsby and Schmidt preferring no change. Also seeing the S&P 500 did see a move towards the upside here, continuing to climb off of the back of the rate decision and the SEP. And the FOMC rate statement and dot plot have been put on the feed for you to read through as well.
Volatility cooling off on VIX 9-day at the moment.
So JP Morgan's Michelle giving a live review says Fed forecasts for economy seem to have a hawkish tilt.
So it was a three-way split. It was 9 for the cut, 2 for no cut, and 1 for 50 BPS cut. $30-year holding, 10-year dropping, Dixie dropping, HYG catching a bid. This is not as hawkish as anticipated. Ten-year holding 416. $68647. We're getting very close, almost right about there. We've unlocked more upside to 6,900. Doesn't mean we go there to this moment. but 6,900, not yet, almost, not quite there yet. Check this one more time here. We do have a new high, though, and the prior high that was put in on Tuesday, targeting upside 689047 on a pullback. Note that we can come straight back from here to 6850. We've done everything that needs to be done here to trade this next one here. Watch out for a pullback here. Note that upside to 6,900 is open. Door is open. As long as you don't get too hawkish or too hawkish questions, the way higher to 6,900, 60 and 60, excuse me, 690 above here is wide open right now. R4, R5 are at 68,971 and 68,866. This might take for us to get up here, the Fed or the Fed chair to not get so hawkish. It may take some time to get there. I can't tell if they're going to do this immediately. What I would expect would be that you'd come up here, hit this one down, tag this one, and then you'd have to wait for Jerome to get up there. Current target 68647. Though we have done everything that needs to be done for where we are, we can pull back straight from here. It's very dangerous right here. Keep your eyes lower on this hourly trigger at 68345. Dealers could push us down just to not pay you as much as you want to get paid. We didn't get the tick on this one, but we caught the tick on this one that we needed. Dixie collapsing, 10-year holding on, 30-year rising. So they're hitting the top end of the rates, which is good. They're just making mortgage holders pay for it, which isn't bad. That's pretty good. And prices are going up. So bond market is okay at this moment. HYG riding higher now too as Dixie falls. A little bit of a roll on VIX, but VIX still holding up, waiting. Fed Chair Jerome Powell. You also have to remember here that I want you to consider the fact that
the S&P 500 last up 0.38% after the Fed rate cut, and the common Fed median projection maintains 25 basis points of rate cuts in 2026.
This is an all-clear sign saying that no matter what, you got your rate cut today, that we're going to get the rest of these rate cuts come hell or high water, no matter who the chair is. You're either going to get it from Jerome or you're going to get it from one of his replacements from now into spring and summer. That dot plot does not look that hawkish. I mean, it's hawkish, but it is not that hawkish. I just took a look at it. They're going to front run all this shit into, I mean, you're not going to be able to price this in May or June.
Seeing the Nasdaq
kind of
positive now,
into January, February.
0.06% after the Fed rate cut.
Potentially March. And the data is not bad. I mean, I'm going to tell you right now out there, the unemployment data is not bad. That means you're going to see inflation ramp. That's what you're going to see. Guaranteed. Whether they're telling you that or not. Well, they probably don't want to tell you that either, right? They want to front run it and give you the fear on unemployment. They will stoke that unemployment fear on you while they price this shit in into the late winter, early spring. Now awaiting the presser at 2:30. We will switch over at 2:15 to a different format where we watch the Fed Reserve and we'll watch S&P 500 and SPY. Yeah, it's wealth effect bullish inflation until we break something or we can't keep up wages. Or something breaks or something terrible happens. A note to you, too, that we did seize an oil tanker that was under
According
sanctions.
to an official, they say U.S. took law enforcement action on ship near Venezuela.
I will make a note to you if you're watching this show right now that when we flew into Venezuela last night, we were actually in international airspace. That is contested waters that Venezuela is claiming as their own, but they're international waters. Then this tanker theoretically, is theoretically under sanctions right now. So I want you to understand. I think I explained this a week or two ago. You'll see antagonization by the United States to create an incident. So you'll see these things portrayed as being intended to create a reaction to start an invasion. I wouldn't expect, though, that invasion to take place until after post-QuapX. So what they'll do is they'll antagonize, and even if something happens, you won't see confrontation typically until about 3 days past QuapX. So you want to be paying attention to that until like the 20th or whatever, 19th, 20th. If you were having like a downside move, pricing that stuff in, the last time we invaded Panama, if you go back and look, it was in December, I think of 89, if I recall correctly. We invaded Panama. Guess when we did that? Just post QuapX. And the market actually bottomed in 1989 in December, I believe, just as we came into QuapX, and then we actually ripped
officials
on the invasion a few days later.
Oil tanker off the coast of
Venezuela. This is the same playbook. What did I call it on Twitter? Fucking Panama Electric Boogaloo or something. So all looks nice structure here. One, two, three, four. This will be the last one here, just so you can read it here. Draw it with you. 1, 2, 3, 4, 5. Should see a corrective move thereafter, either sideways or a downstroke. These should be runners. The last wave is usually runners. Realtors screwed right now. Thought they were going to get a rate cut today, and well, they'll do fine in their refis and stuff. No, maybe not. 10 years still holding up right now. New mortgages still fucked.
Bipartisan Attorney General warned delusional AI chatbot outputs may violate state laws, according to a letter. So Meta, Apple, Microsoft, and Google
Remember, this can fail early.
among 13 companies that received
as we
warning
roll
letter.
into.
So again, there's Meta, Apple, Microsoft, Google, OpenAI among 13 companies that received a warning letter for warning delusional AI chatbot outputs may violate state laws.
Target on SPX 6875.30. I'm going to check some of the options that are coming in right now. You can go to our Discord. You can go to tradethetrigger.com and sign up if you'd like to join us. We have a big Discord. We have traders that trade everything: currencies, crypto, stocks, options, Globex, overnight, you name it, man. We have all kinds of cool tools in there, white papers. We got anything you need, anything you want. We got a guy with a Bloomberg terminal in there. We've got mentors, tradethetrigger.com. We also have a bunch of bots from Unusual Whales, Tradie Ticks, you name it. We got a Gex bot in there. We've got our own Gex stuff in there now. We got our own Gamma suite. Thank you, Bork. Volumes on SPX. Pretty much the same. No change right now. No change yet on SPY or SPX. Prior high, lower high. SPY trying to eke out one last high right here. Time's ticking. Only have 19 minutes left.
Ten minutes away from the bottom of the hour, expecting the press conference with Powell. We'll pop out the video on the feed for you as well.
Also note that we have not taken out the, let me just check a 4-hour candle here. Just a note that we've taken out 80% of the downstroke candle on 12/8, implying a larger move higher at some point. We have taken out 80% of the down candle that I can see. That means an attempt at a new high above 688.39 is theoretically open right now. We'll look to trade supply at 690. I have some other targets at 691.88. Target at 689.11. No big reaction yet on Bitcoin. I'm going to switch over really quickly here in just a moment to the Fed Reserve speech. It's going to take me a few moments of some work here in the background.
Deutsche Bank's Losetti says there was scope to get more dissents. We have popped out the video of the press conference. Again, that's due at the bottom of the hour for you to watch.
I'm just going to switch over here with you guys. Let me just make sure I get everything going on here. We can frame. What do I got going on over here? Here is SPY. VIX rolling down. We're losing some volatility at the moment. I'm going to try to put bookmap up here. Hold on, guys. See if I can get some bookmap up here going for you guys here. just floating right now. Two minutes until Fed Chair Jerome Powell. VIX 9-day closing the gap, trading 1641. What type of chair or tie do you think he has on today? Nice little bounce on SPY just then. Blue tie. Oh, no, is it purple or blue?
projection of the unemployment rate is 4.5%
While as the labour
at
market
the end of this
sentiment
year
has been in
and
decline.
edges down
Voice
thereafter.
news disconnected.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and
Target
stable
hit
prices for the American people.
680,
At
647
today's
pulls
meeting,
some
the
off.
committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term,
That
risks
is
to
5
inflation are tilted
waves.
to the upside, and risks to employment to the downside, a challenging situation.
You look for a sideways
There
or a
is no
sharp
risk-free path
correction
for
and then another
policy
move
as we
higher to
navigate this
690.
tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived.
I'm going to mark the next
effectively a one-time
target
shift
above.
in the
See this
price level.
yellow line right here
Our
above my head
obligation
over
is
there?
to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point.
Now trading higher than R2,
With today's
targeting
decision, we have lowered our policy rate
687.54.
3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help
Keep an
stabilize
eye
the labor market
on
while allowing
Bookmap
inflation to
up there. We're
resume its
coming into some
downward trend
supply.
toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks.
Watch my
In our summary of economic
like
projections,
this.
FOMC participants wrote
Just
down
like
their
this.
individual
Watch
assessments
my up there.
of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis.
That's the
Let me
hawkish
turn
part,
now
the
to
meeting-by-meeting
issues related
basis.
to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh, shit, here it comes.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase,
speed this up a little bit here.
The extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given
You want
rise
to watch this
that?
closely.
Is this an early bet
On the top
AI?
here, there
Is
is
there
a
some sense
correction
of,
going on. I want to just show it to you.
Productivity out there. What's
We had
driving
5
that?
waves. This is 1,
So a number
2,
of
and
things are
3.
driving, what's
You want to
happening in
make
the
sure that
forecast. And
this
I would say if you
diamond
look
here is
broadly at
not
outside
violated.
forecasts,
If you
do
see a
see
violation
pickup in
underneath,
growth
we
in
may
many of
start
those now, too. So
a larger
it is,
move to the downside.
It's partly that consumer
Keep your
spending
eyes
is
on right
held
where
up.
we are.
It's been resilient, and it
Watch this
to
very
another
close to my
degree,
cursor right here.
It is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive.
You want to watch this bottom and then create a new high. If it does not, we're going to blast down. So be watching this very close, this price action.
The baseline
Do
would be
not
solid
buy this
growth next
yet.
year.
Do not buy this.
Steve.
You want to see this bounce, make a
Mr.
new
Chairman, taking my
high, and
questions
then we
here.
can start talking about the next wave up.
You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out
Here's the bounce, mark a
sufficient,
bottom.
insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline?
Here's the box we need to hold right here.
So the implication is obviously higher productivity. And
this green box that I'm showing you right now.
I think
just
productivity has just been.
This is the basis for us trading 690 today.
So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and And that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have
Need to keep
a lot
pumping
of the
here.
December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be
Wanna take
distorted
out
by
this
very
high right here.
technical factors.
And just one more question on
smash
dissent.
that high
I mean,
out,
you
and then
talk
we
about
can
in a
do
very
whatever the fuck we
positive
want
way,
over
just
here. It
given the
doesn't matter.
complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel
Remember,
that we're
if
at
they
that
take
point
your
at all.
stops
I
out down
would
here
say,
or wait
again,
for
these
the
are-
roll
these are
down.
good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling
Who's trying to make a new high right now, the prior high,
notwithstanding the 150 basis points in
at
cuts
686.84.
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed
If that new high is
wait
made,
and see
raise
how
your
that turns out.
stops
That is our
here.
expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Remember, the 4-hour
Claire Jones,
candle on the
Financial
8th of
Times.
December was taken
A
out
lot
earlier.
of people interpreted
That
your
implies
comments
we're going
at
to
the
make a new
October
high.
meeting that
when there's a foggy
We're going to likely
situation, we
trade
slow down.
689.
There wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So
One
in
more
October, I
fucking
said,
candle.
That there
One
was no
more tick.
certainty of moving, and that was indeed correct. I said it's possible you could think about
Target
it that
hit
way,
on a
but I
penny.
was careful to say other people could look at it differently. So why did we move today? I would say point to a
They
couple
could
things.
reverse
First of all,
this for
gradual
another
cooling
pull
of the
higher.
labor
Watch
market
out.
has
These dealers will be
continued. Unemployment
fuckheads
is now
about it.
up
We might get it
0.3
more, but
from June through
be real
September.
fuckheads here for the
Payroll
next leg.
jobs, averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does
Target
build
hit.
on the story, and so far it's only a story that
687.54.
this is that the goods inflation, which is really the source of the excess at this point, almost more than half the
Well,
source
not
of the
quite,
excess
another
inflation
tick,
is
maybe, another
goods,
penny or
is
two.
tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants
No,
to
we
generate.
could hit this one and then do the
Phillips curve
pullback.
kind of inflation.
Or we
So
can, this is
we
good
look at all
enough.
those
We've done everything we
things,
need to do
and
for the
we
next
say
leg.
that this was a decision to make. It obviously wasn't unanimous, and
So this
but
leg right here,
overall,
could it
that was
be
the judgment
here?
that we made, and that's the action we took.
Or even just right
on the
here, it
annual
doesn't need to
reserves
go
point,
any
how
higher.
concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government. Reserves
We're coming
drop
into this
sharply
prior
and
high right
temporarily. So
now.
this seasonal buildup that we'll see
Prior
in the
high at
next few months was going to happen
688.39.
anyway.
This is where
It was
we
going to happen
sold on the
because
attempt
April
that we
15th is April
validated to
15th.
go up on
There's
the
also
all-time
a
high.
secular ongoing growth of the balance sheet. We have to keep
This is our
reserves,
second swipe at trying
call
to
it
trade an
constant
all-time high.
as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20, $25
That's
billion
at
per month.
689.88.
So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening.
Now trading 687.88.
Andrew.
Thanks, Mr. Chairman.
Here's ATH right here where my arrow is up here.
FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. You know, we're not legal commentators.
If you're on TGT with me, it's squeezing balls again.
We don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not
Bitcoin.
It's not the 1970s. Let's put it that way. But we do
winding
have
up right now. Watch out if you're
goals.
short Bitcoin.
And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that in our framework. Our framework, as you know, says that when that's the case, then we try to, you know, take a balanced approach to the 2 things, and we look at how far they are and how long it takes to get them back
screaming higher right now.
And that's very
explosive to close the gap on the
really.
drop on 4.5% yesterday.
And I think ultimately what it says is when they're broadly equally
NVIDIA looks bullish as fuck right now.
You should be kind of neutral, because if you're either accommodative or tight,
Meta catching
you're
a
favoring
bid.
one or the other goal. And so we've been sort
beyond
of
looking good,
moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've
still
cut 3
dying
times.
right now.
You know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the
Watch
economy
out for Q's.
performs.
Q's wants to rip some fucking faces off right now. Remember, Q's outperforms SPY,
Thanks, Mr.
and
Chairman.
the
Edward Lawrence,
individuals'
with Fox
tickers
Business. I
outperform
wanted to ask
early
you,
in December.
The inflation expectations.
So if you're looking for outperform, not from SPOOs, but from
do you see the
tech
tariff
symbols,
price increases
there's a rotation
as passing
going
for the
on in
next
some of
3
tech
months?
right
Is
now.
it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff
NVDA
inflation,
looks
it
bullish
there's
as
the
fuck here.
announcement of a tariff, and then there's, you know, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, you know, it may take, you know.
Q's has a long way to go to get to all-time highs. That's the
tariff
trade
to take its full
638.78.
effect. But once it's had that
It's only
effect,
trading
then the question is,
627, so if you're
isn't that
looking
just
for
a
an
one-time price
outperform.
increase? So we actually look at it, all of the announcements.
First, they have to take out the prior high at 628.97, back test, and then start ripping faces off.
There's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements.
All-time highs, just a few steps away
from
for
goods,
SPY.
Should peak in the first quarter or so, right, or roughly. You know, we haven't been able to predict this with any precision. No one is.
Just a
But
note
call
here
it the
that
first quarter
currently
or so of next year should be
the
the
market
peak.
is cut. We have a gamma
from
bar
here,
above
it
at
should be-
6,900 in
it
SPX.
shouldn't
We
be
just
big. It
traded
should
a
be
high of
couple tenths or even less
6,892.48.
than that. We don't
Watch
really
out for any
have
kind of like
precision on
a
this, but-
liquidation
and after
break
that,
here.
Again, if there are
There
no
are
new
sellers
tariffs
here.
that are being announced that will take 9 months to get fully in. And 9
So
months
if you're
is also
looking
an
on
estimate.
SPX on a 4-hour
Then you should
candle,
start to
right,
see that
there's a
coming down in the
big
back half
fat
of next
bat
year.
wing.
And I want to see if I could address sort of the elephant there in the
We
president's been talking
still have
openly
yet to
about,
make the new high on that,
Fed
but if we do
chairman.
make
Does
that new
hinder
high, there
your
should be a
current job
pullback
right
and then a
now,
swing high like a
or
cup and
change your
handle.
thinking at all?
No.
I want to see like one more push higher here, just ram this shit up,
No mulligans for
and then you get your cup and handle.
Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September.
We just
of
need the tick, and we're
2024,
just a
the
few
yield curve
ticks
basically
underneath
has been
it.
steepening. Why do you think that?
And we're literally pennies
continuing to
underneath
cut
right now on SPY.
especially in the absence of data,
688.17,
is going to bring down
688.39
the
is that
yield on
prior high.
the
We
thing
need to
that
just
will
take it out
move
real
the
quick.
economy the most?
So we're looking at
We
the
don't
real
need the
economy
all-time high,
and
we just need
focusing
the
on
tick.
that. And you've got it when the long bonds
Watch this
move
very
around, you've got to
closely
look at
here.
why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation.
We literally, watch my
break-evens.
cursor right here.
And,
We
you
just
know, they're
literally
at
just
very
need this
comfortable
fucking
levels.
tick
They're
right
levels
here.
consistent. Past
You do that,
once
then we
you get
can
out past
swing
the
this
very
out,
short
even
term
pull it
now,
down.
break-evens are at a, at quite
careful
low,
of this
quite
last leg
consistent with
right
2%
here.
inflation over time. So
This last
there's
leg could
nothing
be a
happening
liquidation
with
break to
rates
go
going
higher.
up out there that suggests concern about inflation in the long term or anything like that.
Or this is part of that whole thing to swing lower.
Same thing with surveys.
So if, let's say we
Surveys are all
smash
saying
up here like
that,
so, then you're going to get
the
a
public
big
understands
liquidation
our
break, so be
commitment to
careful.
2%
It's not quite here
expects us to
yet,
get
but
back
it's
there.
soon.
So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move.
We want to smash into
toward the end of last year,
6,900
which
on
was not to
fucking
do with us. It was to do
SPX.
with other developments.
We want to smash right into
Well,
it.
you just mentioned that
We want to eat some of that
the public
supply.
is expecting you to get back to 2%, and Americans overwhelmingly
Remember
are
that
citing
I
high
told you
prices,
earlier how we
inflation as their
do
number
these
one concern.
inflection points.
Can you explain to them
We went up and
why
we
you're
hit
prioritizing,
those big old band
the labor
sellers, right?
market,
And we
which
said, we're
seems
here.
relatively stable
They
to
came
most
back
people,
down, found out where the real
instead of
buyers
their number
are,
one
and
concern,
now we got to
inflation?
eat into them to break
So
up and away from them.
We, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is
Also
restore
begin looking
inflation
to see if people are
its
rolling
2%
calls
goal,
higher at any
and
point above
our policies
6,900.
is
Dealers
intended
will
to
be
do that.
forced to
But also
chase
have
a
strong
vertical
economy
bar
where
going
real
up
wages are
their
going up,
asses.
where people are getting jobs and
If you're in the
earning
Discord,
money.
you want to open up one of those
we're gonna
Pro
need to have
Tools
some
in there, and it'll
years
show you
where real
if you see ramping
compensation is
call
higher,
buying, we'll
is
fucking go
positive,
vertical up here.
significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Also
Hi, Victoria
note that
Guido.
CTA's Vol Control
Just to follow
Gang
up on that, I mean,
will join
this is now
in.
the third time that you've cut
Trend
this year,
chasers will
and
join in if we
inflation
break
is
above
around
6,900.
3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
You already know what to look
Everyone
for
should
above
understand, and the
6,900. You want a
surveys show
high,
that
a
they do,
second
that
high,
we're
and then we can
committed to
start
2%
taking it up.
inflation, and we will deliver 2% inflation.
Even if
But
we do
it's
a correction
complicated, unusual,
after the
difficult
second high
situation
sideways, and don't
where
lose the
labor
base.
market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much.
SPY taking up the prior high on the last inflection point test on the all-time highs.
Risks. People care a lot about that. That's their jobs. That's their ability.
I'm going to
if they
slide
get
this
laid
over
off or if
for
they're
you so you
entering
can
the
just
labor
see the
force
action.
to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this
Look at
point.
my calls
is that
from yesterday close. They're looking
if you
pretty
get away
fucking
from
good right
tariffs,
now.
Inflation is in the low twos, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price
I'm
increase.
rich here.
Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the
I
labor
wonder if I
market
should
was
take
just
this shit off right
really
here or
strong,
wait.
then rates would be higher, as they were for more than a year. We didn't have
Or
to
wait
worry
for
about
this to
inflation.
fucking-
Sorry about the labor market.
I want to take
because
them off
the labor
right at
market
69
unemployment
maybe,
was
or
very
leave them
low, if you
on.
remember when inflation was very high.
Fuck it.
There was a labor shortage, so we could focus entirely on inflation. Now,
You guys
it's
better be
different. We
making
actually have
fucking money. I
risks to
drew
both.
this whole goddamn thing
And
up
I think
for you out
we're
there.
doing the best we can for people.
Congratulations if you're
They
making
also
money
care
with
about
us
their
here
jobs.
today.
They do care about
the show.
affordability. And the best thing we can do there is both
I'm
to
getting
support
greedy right
economic
now, and I shouldn't be
activity,
so
but also,
greedy.
Make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
By 1 penny, we have the new high and the prior high that could drop us here. There's no requirement to go any higher.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data?
We want to
Why do you
hold
think job growth
6870.
is- To follow up on your comments about job growth, why is it so much
Somewhere
worse
right
than
here.
the official data is suggesting?
Want to hold right about there.
We know, I think this is, I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it
SAIL
will be
moving
corrected.
up
I
right
don't have
now,
the exact month in my
SAIL.
head right now, but and that's just I think
Slide
forecasters
moving up
generally
right now.
understand
Reddit
that.
moving
So-
up,
and we think
continuing
it's
to move
about
up.
60,000
We
a month,
posted
so
those spec
40,000
growth
jobs
memes
could
in the
be
Discord
-20,
earlier.
and that could be wrong.
Hinge
by
kind of stalling
10 or
right
20 in
now.
either direction, but in any
SAIL
case,
moving,
but the thing
SLDE
is
moving,
that's
Reddit's moving
job
still.
creation in a way, that's demand.
HNGE kind of stalling a little
Labor supply
bit.
has also come down quite sharply. So, if you had a world where
What up, extra
there's just
guac?
no growth in workers and you really don't need
What
a lot
up,
of
my
jobs
brother?
to have full employment, some people argue.
You wanna get a
that's what we're looking
bottle
at.
or a glass right
But
now? Hold
I
on.
think a world where job creation
You guys
is
making money
negative,
out there or what?
I just think we need to watch that situation very carefully and
Thanks for
be in a
tuning in, my
position
brother.
where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a
Push
big
them
part of
higher
the
right
story
now.
yet. We don't know whether it will be, but for example, if you look at, you can't miss the big announcements of layoffs, and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a
Bitcoin
little
now
bit curious.
exploding to the upside. If you were
Longer term,
short, I
though,
told you to get
the
out.
question is, what are we going to
Get
see
the
here?
fuck
And we
out.
don't know, but it's there's
Bitcoin now
it may
screaming
be that
higher, trading
in
93,593.
past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. And Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
On the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you. Thank you, Chair Powell. Christine Romans, NBC News.
A note
Wanted to
that
ask you
Trump is
about
scheduled soon.
How the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's
Just
going
a
on in the
note here,
economy, we hear about this a
SPX
lot.
trading 68.93.75. We smashed into 6,900. You know what to do if you watch this show every day.
With low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for
going
way
straight
more than
vertical
a third
right
of
now.
the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and
less than $1 away from all-time highs.
The longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income.
SPY going straight vertical right now.
Having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low, so it's made it expensive for them to move. And we're a ways away from that changing.
Seeing as we're coming into the holiday season here, everybody's making money today.
So a lot of estimates suggest that we just need more housing of
First
different kinds.
eggnog of the season, extra
housing is
guac.
going to be a problem, and
yeah.
really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address
with a little bit
a
of
secular housing
dark
shortage,
rum.
structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated
And
Press.
a Christmas cookie my youngest
you mentioned
made.
on inflation, services inflation being low, goods inflation
Mary
looking like maybe it'll
Chrysler!
peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we
just get out now or get pretty fucking
higher inflation.
Scared
As
here.
I mentioned, most of the inflation over target is from goods. And we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you'll see, you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely.
Fucking Bitcoin,
so
Jesus
I think,
Christ.
again, all across the committee, people see the picture pretty similarly, but see the
note
risks
that once
quite
he stops
differently.
speaking, it's only
And some people do
3:16.
see
He's
the
usually
inflation
here till
risk, and
about
I wouldn't dismiss that
3:40
case.
in the
I don't
afternoon.
dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects.
We've already
for
made an
productivity.
attempt at 6900 3 fucking times. 3.
It may make other people.
We should smash
have
right
to find
over
other
it,
jobs,
make
so
one
it
quick
could have
high, then
productivity
another higher
implications
high,
while
then
also
start to consolidate and draw down.
Social and labor market implications that we don't have the tools to deal with.
We should
But
not
yes, I think we are
auto-reject at this
We're
point.
definitely seeing higher productivity.
Unless we lose
I think
time
it's a little
here.
quick to be saying it's generative AI.
We will sweep lower, but we want to break above it.
The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many.
A little bit of a roll
many
on
things
Bitcoin
pushing
just
in
now.
different directions on where the neutral rate would be. But yes, that argument does come up.
Here is this part right here. You can see it.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen
We're in the
multiple
last
trade
leg
wars,
right
the
now.
pandemic, COVID reopening, period of high
This
inflation.
is the last
I know
leg
your term's
here to
not
go up.
as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm.
Give him the all-time high, then. You fucking just asked
bigger
him.
things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Raise your
Mark
stops.
Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates or yields, to
Give
be
him the
more
all-time
precise, have
fucking
peaked,
high. Send it
while
up there.
key
Give him the
borrowing
big
rates
green
remain
bar.
elevated.
Send
And
up.
that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an
688.83.
unintended consequence because your tools are limited in addressing
Smashing into
individual or household
6,900 in a
liquidity
few
constraints,
moments.
insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right, be careful here. Watch out for a roll here. Sometimes when he ends, we lose all of that volume. We could begin right now. I'm out, by the way. I'm out. I'm done. I'm not chasing this. I'll wait for a fucking swing. If we get one. If we even get one right now. There's no requirement that we do this right now either. Let me just show you something here if I can. Hang tight here, guys. Let me switch over here, go to 1. We can, but let me just show you something here. So just look at this right here really quick, okay? You see that this is SPX as we had charted out for you yesterday in Gamma. You see it? Now we're going to talk about this really quick, okay? I want to show you this right here. We don't really need to go any higher. Let me just show you this here at a close-up inspection, okay? You see this high right here? That one right there. We made this high without jumping up and over. So this is an inflection point, right? We can come right back down here, hit this, and then hit this one. And we might even get a flush. So if we can't hold on to this, there's no requirement that we actually go any higher. We can actually come down here and, believe it or not, sweep down even lower. So be very careful here. Remember, I've said to you, even if we go up on a Fed day, we oftentimes will come back out, flush all this stuff out, and then back up again. Just be aware of that on this downside here. I wish, or I hoped that we could take out this 6,900. We had the prior high here. That's all that's required. My hope was that we'd come back up here, slam up, get the 1 and the 2, and then maybe get some Diller action up here. But it's not required at this point. So just want to let you know, if you want to wrap it up, you can. What I'll do right now is I'm going to switch over to... I'm going to get out of this. Just hang tight here for a second. I'm going to go to the trigger screen with you here. Just going to take a look at all of this here. On SPY, we beat that one right there. Still missing one more tick up here. On SPY we are, but not on SPX. Also remember that SPY is a derivative, right? That fucking thing. Still like to take out I'd like to take out 689. Still haven't done that one. Here's the halfback trade right here. Let's just look at this together. There's 1, 2. There's 3. We're on the last one right now. This is the 3 right here. I'll make sure I got these right. That wasn't it either. We might not even be in 5 yet. Check this. We're not even in 5 yet. So we're not even in our 5th wave as of right now. It's a pain in the ass to watch here. Sorry. I'm like going back so many days here that here's your R5 right here. Okay, we're going to go slow with this. So we've got, this is your 5th wave right here. There is a halfback trade lower. So you got to watch out for a flush either now or later. Only leave runners on. You can do this a couple ways. You can do this where you're closing out, take the money, and then buy something cheap right here for the up move up here. Stops underneath. 5th waves are like, this is the most, this is where the money is. This is where the FOMO is. Now, there's something else going on here, too. If we're able to break above and price to this upside, you want to see like 2 highs like this. Now, sometimes we trigger a chase higher and we just super fucking ramp. Like super fucking ramp. 692.50 would be the target if you want to know. Right there would be the target. It can go to 65, but you'd want to be up here, one new high, and then ram it. And that would be dealers following along on rolling calls. We don't know if anyone's going to be calling rolling calls today. It is only Wednesday. The continuation could take into tomorrow or whatever. But I do want you to know that the moment those calls are done being bought, we will trade this down below here. Another note, too, is that the half-an-hour trigger is now crossing the hourly trigger, which should super ramp this price to the upside. When we have this cross, price tends to want to come back to it and revisit it for a flush. Just be aware of that flush down here. It may not happen at the moment. See this half hour right here? Watch this right here. So this flush could take until, tomorrow to this 4 hour. It may not happen today. I'm actually pretty bullish here for this upside move. Move some of this over here. We'll leave this right here for you. Watch this closely. This is SPX. These yellow horizontal lines are speed bumps. The actual top is 7,000. But I don't think we get there. I think we can do like 69.25, 69.50 is possible before the reversion trade lower. Somewhere right about there. If you can get dealers to jump on board and be forced to chase this higher, watch that this angled line right here. This one right here. Watch that one. Trade is higher right now. We are now in that fifth wave with an extension possible. SPY now trading higher, 68.93. Can't see shit here. This is this is what I've got for a high, like right about here. Right here is where I've got for high. This is the first of those two stops I had. Like right the fuck where we are right now. Just make sure I get this right. This is pretty goddamn close. I would get the fuck out. I'm already out, so there could be an extension from here, but take the fuck. I'm gonna assume we gap up tomorrow a little bit more. The gap up on tomorrow is, if we do the gap up tomorrow, it is. You want to get some shitty zero dates or something? Make them cheap, take your money and run. But for a gap up tomorrow on open, 692.22. And then you'd get the roll down for the halfback trade. Do you want me to show you guys what this looks like? I'll give you an example for the overnight here for the gap up. It looks just like this. You ready? We're like right there right now. Right there. What did I say? 692.33. It's right there. 692.28. Wednesday, Thursday, 9 a.m. Right there. What we'll do is we'll waste time in here. We'll make this a 4-hour bar at some point. This will become a 4-hour bar. They'll park our asses in here to the close. We'll fuck around in here. There is a, that's the target. Make sure I get this right. That's your first one right there, and that's your second one right there. There's your first target right there. And you're going to get another 4-hour sweep right here. Right in here. And then up. There's a couple other things we could do here too. This could actually look more like this. One, I got this wrong. This, like this, this, down. So you can see it. Wednesday, Thursday, Friday. Wrap that shit up in the next week. Friday after 10 a.m., Monday, something like that. Mean reversion trade down here. Next one is right there. There. One, two, distribute, come back down. There's 90.74. It's your double top, and then you're up here. Not double top, but this should actually go up a little bit. About there. Smash, smash, smash. Drop it. Here's your hourly trigger. You can see it coming up. As long as you're above your 1 and 5, it's distribution time. Your hourly will come over here. Right over there. Wham, wham, wham. That's 692.50 right there. Unless you do this all the way to Friday. What time is Thursday at 6? Oh, this is Thursday at 1500. Okay. All right, fuck it. That's what it is. Thursday close. What do we have for data on Friday? Maybe we have something on Friday that's bad. It's something, I don't know why we've got this going to, what I got right here, it's Thursday at 1600. 1500, 3 p.m. on Thursday. Not, it doesn't have us going all the way to, unless, I mean, the only other thing I'd think of would be 6500, which would put us closing bell on Friday. If dealers chase this into Friday close, that could happen. It's possible. I'm going to rein it in a little bit here because I do want to tell you one quick thing here. I'm going to give you one warning here. Listen to me closely. Just one quick warning here. There's a lot at play here, okay? There's a lot of play that I need to talk to you about. When we move into this distribution here, right? You have to hold the plane, okay? You have to continue to make new highs. If you fail to get like a second new high, be very careful. It'll dump. The other thing you need to think about here is oftentimes, mark my words on this. This is the big one. This is the rule. Oftentimes, when we go into the end of a day like today, we'll get hammered tomorrow. We'll literally like shank this whole entire thing down, then do the next leg. If you're going to carry this trade over, excuse me, into Thursday and Friday, I want you to take profits and try to buy a dip to do it. So don't give back money to the market. Are you understanding me? Cap, I got my shit blown up. So you shouldn't be doing that. And for the rest of you, you should be waiting down here to buy the dip on the hourly trigger, okay? And especially on these binary events. I've only seen it rarely on downsides where it mean reverts the next day, only one time. On the upside, I see it about 50% of the time, so there's no edge on the upside move. I see better continuation on days after on the downside. On the upside, way too frequently I see that shit just get shut down. And the reason being is you've got dealers chasing right now. So when you come up here and you're, they're not chasing yet, but if you're going to start a new position here, look at this bottom right over here. This way to watch this right here. This is SPX. You really don't want to be starting a position in cash market unless we're up here like this. Then you take that trade right there. Does that make sense? So you get up above, you close it out, you take that trade right there, and then we start the fade. Make any sense? So I want you to think about that today, tomorrow, or whatever. The basis of this trade rests on this 1 hour candle right here. So if you got a 1 hour candle at home, this whole trade is based on that right there. Now this will go higher. You want to see like all the new lows should be slightly higher and continue to have new highs for this trade for continuation. So just remember this, okay, as I'm speaking to you out there in weirdo land. He already spoke. He was speaking earlier. I'll read to you what he said. He said, we'll approve. Why did I do that? Trump says U.S. seized oil tanker off the coast of Venezuela. We'll be talking about technology and AI today. Trump admin touts pulling nearly 10,000 truckers off the road for failing English tests. I spoke to senators today on AI regulation. He says, we'll approve plant construction in a matter of weeks. Don't see why we can't have 20, 25% GDP growth. The market should continue to go up with great results. We should be able to do more than 3 to 4% GDP. Rate cut. Oh man, this is not good for the future. We're gonna fuck our kids. The rate cut was a small number that could have been more. Switzerland paying almost nothing. The Fed interest rate cut could have been doubled. You can have tremendous growth without inflation. Oh man. Keep this thing. Just remember, you're buying dips here to push higher, higher, and higher. If you fail to get new higher lows and new higher highs, this should be 3 swings up and then a roll. The one warning I have for you is if you're like full account into the close today and you see a mean reversion trade overnight, don't be knocking on my door and be like, hey, Cap, you said this and said that. Now, if you made money today, you should be pocketing that money. MOC close imbalance is huge right now. So I can show that to you really quick. MOC imbalance to the buy side, slightly less on S&P 500, huge NASDAQ, slightly less on Dow, huge on Mag 7. You'll see this in December where you'll get a early ramp in individual tech stocks and NASDAQ, and then you'll see SPY pull up the rear towards January and March. So if you're looking to do show this trade through if you're looking to put this trade through, tech is the way to go in my viewpoint. We'll bring this over here for you. Coming to the close now. If you can catch any downside move here into this bell, And I don't mean selling it, I mean buying a fucking dip on this. Yeah, Demi, I don't know if it's Friday or Monday. I'd drag them out to Monday, but for some weird shit reason, I've got this hitting the high on Thursday at 5 p.m. But I could be wrong. I'm doing this shit. You guys got to understand here. I want to say a few things to you out there. What you guys are seeing on the screen and me watching him and doing all this shit and trading when talking to you guys, it is extremely hard. It's testing everything I can do. So even this preliminary right now, I probably need an hour or two for the market to digest. So I appreciate you bearing with me out there as this stuff changes. I have a lot going on in my head, and I got a lot going on around me, and so I apologize if this isn't exactly accurate. But I want you to know there's a lot going on, and I have to like think all of this through in the back of my head, and it's very complicated. It's complicated with the added, streaming, bouncing between screens, talking to you guys, and opening, closing trades, and all that kind of stuff. So I appreciate your guys' patience with me. Most of these guys get an hour, 2 hours, 4 hours to think this shit through and package up a video for you that they don't say anything. They don't commit to anything. You know what I mean? They don't tell you what they think is going to happen. They tell you both sides and they walk away. So, and they have time to do this. I don't. I do this shit live and it's not easy. So I appreciate your patience with me on this stream. For the rest of you out there that only show up every once in a while, check us out. We're on Monday through Friday, 9:30 till opening until the opening bell, the closing bell on cash market hours. Check us out on tradethetrigger.com. Just our Discord membership is worth every fucking penny. Period. So if you want to check us out, please do. We've tried to keep it as cheap as fucking possible. Stream is fucking free, of course. And show up, subscribe, keep coming back. What time is it right now? 3:54. I want to thank you for joining me today on the FOMC rate decision. Technically, I told you earlier that I had us going down, but I told you that I thought we were going up, right? And that I was long calls. I told you yesterday that I didn't like the fact that we were trading down into this announcement. I did not fucking like it. I wanted that fucking high. If we got that high yesterday, we would have sold today. That goddamn no high yesterday told me we were going up today, not down. Sorry. Fucking bastards. Not you guys. The market. I hate binary events trading down into them, and I fucking hate binary events trading up into them, because even though you're like, technically, we're going to do this, we don't. We go the other fucking way. So if you did get calls with me today, congratulations. If you did hear me tell you that we should go down, but I think we're going up, congratulations. If you read the fucking lines that I drew for you, I don't know, man, that was pretty fucking accurate. I don't know how good you want it to be. Please show up. I'd have bad days here. You guys can see me lose I got strung up yesterday. I got hammered yesterday midday. And they pulled the whammy on us today, right? Up. Fuck this. I do want to warn you one other thing. To think that the low is not in on this low we just had, I don't believe it. I'm going to warn you guys. We likely see another fucking low before QuapX. And I'm going to warn you of something else. That fucking VIX expiration, we can come in one fucking day. Listen to me closely out there. We can come in one day and have like a murder bot on like Tuesday. You don't believe me on that shit. Enough of you have stuck around that you know. We can come in and it'd be a bloodbath, and then the next day it's like nothing happened. So to think that you can't buy a dip in the end of the year here is wrong. There's a path higher. There's a path higher into January and February and March. But to think you're not going to be able to buy a fucking dip, you can. If you missed today, remember that you can always come back to buy a dip on the hourly trigger and the daily trigger. TradeTheTrigger.com. Happy holidays to you out there. I don't care what you celebrate. Merry Chrysler. Merry Christmas. A happy Hanukkah. What else is we got there? We got Festivus for the rest of us. We've got an African holiday as well that people celebrate. And for some reason, it's not coming to the top of my head. I'm very tired right now. But no matter what you do out there during this season, please be safe. Take care of each other. Don't get like this part of the season I hate. For me, it's very stressful. I have a lot that I have to take care of. So I hope that you don't have to go through that this holiday season. I want you to like take the time that you need when you can, slow down when you can. Don't drink and drive. Don't smoke weed and drive. There's Lyft out there. There's Uber out there. Be nice. And if you can't be nice, what do? You do the Irish goodbye, right? And I'll see you the next time. I want you to have a wonderful evening. If you're in the Discord, I'll try to get you a better outlook. What I'll do is I'll put the Elliott wave counts for ES out for supporter level tonight and some SPY, Qs, outlooks as well. If you're in that fucking Bitcoin and TGT trade, congratulations. Bitcoin TGT, congratulations. Woo! Sorry. I'll see you guys. How many minutes we got? 3 minutes left. Thank you for joining me today. Appreciate you out there. Yeah, treat your wife's boyfriends good too, please. Don't force them to come home. Don't force your wives to come home until after Christmas. That's so bad. I'll see all of you guys tomorrow at 9:30. We'll still be here all week. And also, a note to you, I will be fucking trading with you through Christmas and New Year's. I don't have any plans right now. I'm trying to like peel back what I'm doing. And also my daughter, my oldest daughter, has a medical procedure coming up. I'm fearful for her life in this thing. I haven't talked much about it publicly. But I will be home with her, making sure that she's still here with us. You guys, some of you guys know her out there. So I'll be here for Christmas, New Year's. If any of you guys look, if the market slows down again, you're looking to trade with somebody, I will be here for those like wrap the whole year up and whatever, which is where we make a lot of fucking money, right? That last couple days, there's like a day before Christmas and a day before New Year's. There should be some pretty good money. So we'll try to do that together this year. And I might be gone 1 or 2 days. I'm not gonna be gone here every day, but if it looks like we get those Ramporama days, I will be trading with you. The stream will be up without it, and I'll give you the plot, of course. And the plot on, if you guys ever watched the show without me on it, it's fucking baller. Like, I'll draw the whole fucking day out, and it goes like exact. I don't know why the fuck it happens when I'm not here, but it does. So I don't know why that is, but stick around, hang out. I'll see you. We'll celebrate Christmas and New Year's together. And I want to say something to you all out there. I really appreciate you all being here this year with me, and I hope the fuck we can get together again and do this next year. And I'll see all of you guys tomorrow at 9:30 in the morning. Woohoo! It was a good day.